Good morning, everyone. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, a rally on Wall Street. The Nasdaq 100 has pushed into a bull market for the first time in almost 3 years as investors, they load up on tech stocks as a safe haven from the bank chaos. Names like Nvidia, Meta, Tesla, Seagen, and Warner Brothers, they're all leading the index higher here. The S&P reversed its recent losses, logging its highest close yesterday in 3 weeks. This all comes as investors bet that peak interest rates are near and banking jitters begin to cool. And second thing you need to know, fears in the banking sector, they've seemingly begun to ease, but the FDIC is still facing some pressure. The agency is reportedly considering making big banks pay up even more. According to Bloomberg, the FDIC is allegedly planning a special assessment on the banking industry in May and could potentially tap big banks to help shore up the losses in the $128 billion deposit insurance fund that it's set to face. And third thing you need to know, more details emerge on Alibaba's historic breakup. The e-commerce giant says that it will give up control of some businesses that it's splitting off in an effort to better prepare them for their eventual IPO. This will be the biggest restructuring in Alibaba's history and comes as the company deals with a regulatory crackdown in China that has wiped out roughly 70% of its value.
Well, the Nasdaq 100 has entered a bull market. It's on pace for its best quarter since 2020. The S&P 500 is also rallying, reversing most of its losses from the banking crisis. Our Jared Blickery is here at the Wi-Fi Interactive with a breakdown and to talk to us about it here. So, yes. Jared, really interesting here. It looks like like we were talking about, the best quarter since 2020, possibly the best first quarter going all the way back to 2008 for the Nasdaq 100. But we'll have to see how it goes today and tomorrow. Yes, and 2008, one of those infamous years. That was before, well, that was right in the middle of the global financial crisis. Lehman would be 9 months later. But let's take a look at the Nasdaq 100 here. When we talk about bull markets and how they are defined, as well as bear markets, there are different definitions, but what we're dealing with here is a 20% rise off of the most recent lows. So you take this low that we had in December and you go all the way up to this close here. Guess what? That is 20% finally. This one just missed it by a hair. How different is a market today than it was 6 weeks ago? Well, that's arguable. So 20% is a bit arbitrary. Let me show you something else. This is the second bull market that the Nasdaq 100 has had, and the first one was a failure. Here is late 2021. This was the all-time peak in the Nasdaq 100. Came down. This was a bear market. This was not a bull market, but when it came down here and rallied 20% off of these lows, that was a bull. But guess what? It came back down and it took out those lows and it failed. So now we are in the second Nasdaq 100 bull market of this bear market that we've had in the S&P 500. If your head is spinning right now, guess what? It's the S&P 500, this guy right here, that really matters and kind of sets the tone with respects to bulls and bears. Nevertheless, this is going to generate some headlines today, as it did yesterday after the close. Traders pay attention, the retail investors pay attention. So if the S&P 500 is able to get into bull market territory, and really I'm just looking at the 200-day moving average and the slope thereof as a better indicator, things are starting to point in the right direction here for the indices, guys.
So thinking through, Jared, some of the biggest players that really tipped tech into the position that we've seen with the Nasdaq 100 now getting into a bull market and some of the biggest outsized moves to the upside within tech. I was looking at software particularly here. I was taking a look at names like CRM, Intuit, ServiceNow, even into Paycom and Workday, and many of them, as you're taking a look at those moves over the past 13 days, not shabby at all.
Exactly. This is only the last 13 days. And here's where we get into something really interesting. You're noting the big moves in software, and in fact, we're also seeing that in semi. But the big question is, how can we explain the movements in tech? Well, let me show you what I have here. This is the Nasdaq 100 versus the Nasdaq Composite. Here's year to date. Nasdaq 100 up 17%, up 20% off the lows. We know that's the new bull. The Nasdaq Composite, which is much more broadly based than the 100 stocks that are in the Nasdaq, in fact, it's about 3,000, that is lagging. That's only up 14%. That is a big difference here. And the reason that is happening is because of the influence of the mega caps. So we have the contributions from software, we have it from the semiconductors, but it is these mega caps on the left-hand side of the board of the Nasdaq 100 that have really been driving the gains. Nvidia up 17.5%, Meta, and this is only over the last 13 days, Meta 14%, Alphabet 12%, Microsoft almost 13%, Apple 8%. So you put it all together, you don't have these big guys coming along, you really can't have a party, but when it's only the big guys and it's only tech, that creates problems. But let me show you what's happened over the last 13 days in sector action, financials. We all know that story. They've taken a big hit, but everything that's outperformed the S&P 500, that's everything left of this symbol right here. XLK, that's tech. XLC, communication services. XLY, that's consumer discretionary. Those are the mega cap sectors, and those are what's outperforming.
Yeah, and a couple of additional points to make. I mean, part of the outperformance has also been the rotation out of the financials in some part and into tech, which is kind of oddly seen as a haven right now. As interest rate expectations are coming down, that's also something that perhaps has helped technology. But when you talk about the divergence, by the way, between the Nasdaq 100 and the composite, I just noticed another subgroup that has not done well this year, and that's biotech. I was looking at the XBI, which is the biotech ETF. Now, some of these are in the, not necessarily in the NASDAQ, but a lot of them are. And if you look at the year-to-date performance, it has not been great. And so I wonder if that's something, too, that has been holding back the broader NASDAQ composite. It's interesting to not see that participation there.
That's right, Julie. When we think about the NASDAQ stocks, a lot of tech stocks and also biotech stocks. And so here's our pharmaceuticals. Not all of these are biotech. As you said, Julie, not all of these listed on the NASDAQ, but you can see a lot of red here year to date. This is healthcare, a lot of times considered a defensive sector, but that has to do with some of the larger names. When we talk about the smaller names, well, they need a lot of capital to operate. What has happened to the cost of capital? It has gone up dramatically over the last year. A lot of smaller companies, and you'll see this in the performance of the Russell 2000, a lot of these smaller companies are struggling to refinance debt. The longer this bear market, well, not in the Nasdaq 100, but the longer this stagnation goes on here, the greater that will increase. Now, here's a 10-year T-note yield. I want to show you one more thing here. Here's a 3-month chart. Here is the beginning of March. We saw the 10-year pop above 4% for the first time in a while. Then it came down and crashed below 3.4%. This was a huge move, and with this downdraft in yields, that's what facilitated the mega cap trade. That's what facilitated the tech trade, because people are looking at those longer duration assets that require a lot of capital. They're thinking, all right, the economy may be turning, the Fed may be pivoting at some time in the future, and that is what is behind this huge move and this rotation that we've had into the NASDAQ stocks, into tech stocks that we didn't have last year. So far this year, the first quarter is a flip of what we had last year. NASDAQ leading, Dow lagging. That was the opposite last year.
Yeah, and that's a great point about rates coming down at the same time because of what's been going on with the banks and their cost of capital potentially going higher.
Yes.
You know, does that mean that lower rates are a wash because banks are still going to be charging higher rates to retrieve some of that? We'll see what ends up happening, but that's something too that is, as you said, hurting the biotechs.
Yep.
Thanks, Jared. Really great look at what's been going on. And speaking of the banks, that's where we are now. Let's talk about the FDIC. It's reportedly mulling more support from big banks. That's according to a report from Bloomberg. And it comes after the country's 11 biggest banks agreed to create that $30 billion rescue package for First Republic Bank. So what would this basically require? It sounds like it would require those largest banks may be coughing up more because the FDIC is facing about $23 billion in additional costs because of the recent bank failures. Again, that's according to that Bloomberg report. And normally when something like this happens, they do a fee assessment or, you know, a charge across all of the banks. Apparently what they're considering is weighting that charge more heavily towards the larger banks. They usually consider size, but it sounds like they're even going to more consider size when they try to figure out how much that should be.
Yeah, and that's the crux of it here. I mean, all of these banks typically pay into some type of insurance fund in the event of any strenuous kind of hardship that one bank or another faces. And because of that, perhaps insurance policy, as they would look at it, they're able to tap into that in order just to make sure that they've got enough cash or capital and able to weather through whatever or however long that period might be. and typically to avoid a collapse. However, given the run on the banks that had taken place, many of them unable to outright avoid it without either some type of partnership or injection of capital or deposits coming from other banks, and even some type of major and swift move or action from a combination, the consortium of the Federal Reserve, the FDIC, and the Treasury. And so now it seems like some of those larger banks, not only is this beneficial perhaps for them to be able to purchase more into, or at least invest more into as well, but I think at the end of the day, it's really just regulators trying to get a better kind of normalized view of exactly how much needs to be within this fund for hopefully the crisis doesn't come, but for the next crisis.
Well, and who should shoulder the responsibility at a time when maybe the smaller community lenders are a little bit more delicate? This is going to have an effect on the bank's balance sheets and the bank's bottom lines. Just for a little perspective here, this isn't the first time the FDIC has done these special assessments. There was one in 2009, for example, and JP Morgan said that it took a $675 million hit to its earnings in the second quarter of that year because of that assessment. So this is something, when this crisis started unfolding, one of the initial takes was this is going to have an effect on the profitability of these banks. And the more information we get seems to be shoring up that view that indeed this is going to have an effect on the profitability of the banks. The one other report that we should mention over the past couple of days is that the White House is talking about imposing tougher rules, more regulation on mid-sized banks. In other words, in effect, maybe reversing some of the rollbacks of Dodd-Frank from a few years ago that lightened regulations of mid-sized banks and perhaps paved the way for the collapse of SVB, for it to take on more risk, perhaps. So that's something that sounds like maybe the White House is mulling ways to not wait for Congress to act on that particular measure. So even though it feels like the crisis is abating, there's still a lot going on behind the scenes in order, to prevent it from worsening again, and prevent it from happening again at some point in the future.
Right. Well, we got to talk more about that prevention, because to help make sense of just how long the market's upward trend will last, plus much more, we're joined by Andrew Sheets, who's the Chief Cross-Asset Strategist over at Morgan Stanley. Andrew, great to have you here with us this morning. Perhaps we can actually pick up where we left off, because it is still the looming question of whether or not the banking crisis is over.
So I think when we are considering the pressures facing the banking sector, I think we moved away from a crisis element of that stress. I think the regulators, the officials have acted very aggressively to inject liquidity into the system, to address the immediate shocks to the system. In that way, I think we're dealing with something that's very different from, say, what the banking sector faced in 2008. What it's still facing, though, is a longer, more drawn out question of greater conservatism, because I think the events of the last several weeks have given enormous incentives to banks in both the US and Europe to be more conservative with capital, to be more conservative with funding, to pull back and tighten their lending standards. And that tightening of lending standards was actually already happening before these more recent events. So it would further encourage that trend. So I think the way investors should think about this is that we're not going to have, or it's much less likely that we'll have kind of an immediate shock from these events. But the impact is going to be long lasting. It's going to hit with a long and variable lag, and it is going to likely result in weaker growth than we would have had otherwise.
I guess the question that we're all grappling with is how much weaker growth, right? And that's something that Jay Powell is obviously grappling with too. He alluded to that they're trying to figure out, is this equal to 0.5% in interest rate increases, right? And that's not something that we are yet able to quantify because of the long and variable lag you were discussing. But given that information is still outstanding, how do you strategize in the meantime? How do you try to sort of game it out?
So I think that's exactly the right way to put it. We actually have these two large headwinds for the economy, these two large challenges for the economy, the most interest rate hikes since the early 1980s, and then this situation in the banking sector where banks were already tightening lending conditions much more than they do during kind of a normal slowdown. And then you have events that would seem to encourage them to do that even more. And yet the impact of those tighter lending standards, it's not going to show up in the data for several months at a time when the full impact of rate increases is not going to show up in the data for several months. So I think as an investor, I think the way to think about this is to think about, what regime are we in? What sort of patterns of performance does this sort of economic data, this pattern of data represent? And I think the data remains very consistent with an environment where a hot economy, an economy with a healthy labor market, high inflation, low unemployment, is slowing rapidly. And that sort of deceleration has been at the core of Morgan Stanley's economic forecasts. I think that's very consistent with some of the trends that we see coming out of indicators like bank lending or like the index of leading economic indicators. And I think these recent events, unfortunately, only encourage the idea of a growth deceleration. So, from our standpoint, it's welcome that we've had a nice bounce in equity markets, over the last couple of weeks. I think this is an environment where ultimately investors want to use these opportunities to be more defensive, to rotate more into high quality fixed income, government bonds and investment grade bonds. And I think that is a type of strategy that is going to be rewarded and is often rewarded when growth is decelerating as we expect it to.
You mentioned that it wouldn't show up in the data for a couple of months. And so with that type of lag, does that mean that we could very well be experiencing perhaps the early phases of a recession before the Fed initiates some type of pause or a pivot?
So I think that's exactly the risk. And this is hard for the Fed. This is a really difficult thing to weigh. Inflation is a lagging indicator. Jobs data is often a lagging indicator, by which I mean it often turns and moves later than other forms of economic data. And the Fed is in a very difficult position where inflation data, the most recent data we have, was still relatively strong, was uncomfortably strong. And yet there are also these other elements that are affecting the economy, bank credit, the effect of the rate hikes they've already done, that are hitting with long and variable lags. And so I think there are a couple of takeaways. First is I do think this puts pressure. This makes the Fed's job difficult. It's not obvious to lower rates. It creates some risks that the Fed is not going to be able to be as dovish as the market would like as quickly as they would like. And the other thing I would note is that when I think it comes to interpreting what the Fed will do, more rate cuts from the Fed is not always better. If we think about some of the best market environments that followed Fed interest rate hikes, something like 1995 or 1997, 1998, those followed relatively small reductions in Fed rates, consistent with just kind of tapping the brakes a little bit or tapping the gas a little bit, moderating that. Whereas when the Fed has cut a lot, and currently the market is expecting the Fed to cut a lot, that's been more consistent with some of these more difficult market environments. So even though in the short term, I think the market wants the Fed to ease more, I think as an investor, a scenario where growth is a little bit better than we expect, but that means the Fed eases less, I think that would actually be much more consistent with better market returns.
Yeah, in other words, be careful what you wish for in terms of these cuts, Andrew. Finally, I want to ask you, because you look cross-asset, right? And you talked about some of the places that you're looking right now, but I wonder if there's something that you think is sort of being overlooked that to you, I always hesitate to use the words screaming buy, but right, like something that's super attractive right now that you think is not getting enough love.
Well, we think stocks in Asia are attractive. If I think about the reasons why we're cautious on developed market equities, it's a function of relatively high valuations, decelerating growth, high inflation, lots of central bank rate hikes, and then all of those rate hikes making cash a pretty attractive competing asset to some of these markets. Those statements don't apply in Asia. Asia generally has much more reasonable valuations. We think its growth accelerates this year. Inflation in Asia is much lower. Central banks across Asia are not nearly as hawkish, and generally cash in the region yields a lot less. So, we think this is an environment where in our hierarchy, we think emerging market equities are most attractive. A number of the large Asia markets, China, Korea, Taiwan are large portions of that. Japan would be second in that pecking order. And we think both of those markets are more attractive at the moment than stocks in the US and Europe.
Andrew, really interesting stuff. Thank you so much for joining us this morning. Andrew Sheets, Morgan Stanley Chief Cross Asset Strategist. Thanks. Shares of Alibaba up very slightly in the pre-market. On news, the group is considering giving up control of some of its business units. Earlier this week, Alibaba announced it would split into 6 separate companies, each with their own board and CEO. And then on a call yesterday, they gave a bit more detail. Executives added that Alibaba will decide whether to retain control of those individual companies after they go public. The news of those possible spin-offs or sell-offs or public debuts, it comes more than 2 years after Beijing's crackdown on tech giants wiped out around $1 trillion in market value of top companies. So Alibaba shares have been rising since it announced this plan, and it has been fluctuating a little bit in today's session, right now in the green.
The U.S. Treasury market has seen dramatic price moves, shaping investor sentiment since the collapse of Silicon Valley Bank. The standout within this volatility has been the swing in the 2-year Treasury notes. Since peaking on March 8th, the 2-year yield has dropped more than 1 percentage point, meaning that the market is pricing in a hefty cut in interest rates by March 2025. You can read all about this in today's morning brief written up by Miles Udland, up now on the Yahoo Finance homepage. But for a deeper dive into what this means, we welcome in Lee Farage, who is the State Street Bank Head of Macro Strategy for North America. Great to have you here with us this morning, Lee. First and foremost, you were just listening to some of our conversation around the broader banking turmoil and what this means for the Fed. I mean, what do these events mean for the economic outlook, even more so going forward from here?
Well, I think as Andrew articulated very well, it's still very early to say. What I would say, if the crisis stops here, which I think it should, I don't think there's any reason for it to extend from here. If it stops here, I think the impact on credit from the crisis, the pullback in credit in the future, will be less than people think. There was this assumption that all local banks are going to be pulling back on their lending facilities. I don't think that's true. I think it's a very mixed bag. I think you have some weaker banks and you have some strong ones. I mean, SVB was bought by another regional bank, which, clearly there are them that are stronger as well. So I think this idea that we're going to see this big credit crunch, this big pullback in credit, I don't think it's true. Look, it was ongoing anyway. We see that from the senior loan officer survey. We're seeing tightening in credit conditions. You expect that. With dramatic rate increases, with thoughts of recession in the future, you'd expect that to some degree. The big question is, how much of a slowdown in lending do you get? And does it offset the excess demand we still have in the economy that so worries the Fed and is leading to sticky inflation?
And then, Lee, the question is, if indeed you don't have that big slowdown in lending, right? Either the market is right or it's wrong about the Fed cutting rates this year. Do we have enough information at this point to even make that call?
Arguably not. I would say the market is wrong. I mean, that's my job. My job is to make that call. I think the market is wrong. I don't believe, again, caveat that with this, the banking crisis doesn't return or extend. I don't think the Fed will be cutting in the second half of this year. We still have excess demand. We have a very strong consumer. We have a very strong labor market. We still have excess savings from the pandemic. And the US is a fixed rate economy. So whereas you look around the world, you look at Australia, you look at Canada, the Bank of Canada have probably have paused. RBA are probably going to pause next week. Bank of England maybe after the next hike. There you have mortgage rates that are much more variable. 80-90% of mortgages are variable rates. In the US, 91% of mortgage payments are 30-year fixed. The US consumer is not hurting. That's why we have this excess demand. And as long as that excess demand persists, you're going to have sticky inflation. And this is why, when you think through to the year as a whole, it's very difficult for me to get a situation that the Fed will be cutting by the end of the year, unless we have a complete collapse somewhere. And for me, that's still not on the horizon. Tough times ahead for sure. And I think 2024, they will be cutting because we'll be in recession. But we're not going to get there yet because we have to work through this excess demand and this sticky inflation we've still got.
So for businesses that are still trying to prepare themselves right now, are there places in the market that you are still kind of staying away from or that you would be cautious of given everything that you just laid out?
Yeah, I mean, I'm generally cautious of most assets at the moment. I mean, cash is king for me right now. I'll be absolutely honest. We get a decent return in cash, not in real terms, but But hey, I still think cash is the place to be. I wouldn't buy duration yet. I think we're going to see 10-year yields back up towards that 4% level that we saw in March, earlier on in March. So I wouldn't be dealing with duration yet. I would be in the short end. I would be largely in cash. And I'm wary of equities. If we have to reprice the Fed, if we take these cuts out, that's not really going to support the equity market. We're not going to see a repeat of last year. And we've been pretty much around 4,000 in the S&P for about the last 4 months, beyond gyrating around it, but pretty much close to 4,000 for the last 4 months. So I don't expect to see a lot of movement there. Still with a bias slightly to the downside for equities, though, I must be honest. So for now, I'm looking at cash. And then, if we see 4% yields or above, then I'm going to think about duration trades.
Lee, really interesting stuff. Don't be a stranger, please. Lee Farage, State Street Bank, head of macro strategy for North America. Appreciate it.
My pleasure. Thank you.
Coming up, Walmart shares are higher thanks to an upgrade. We'll tell you who's feeling good about the retailer and why next. We're getting some Bed Bath & Beyond headlines right now from a filing, and they're not great. The company is filing to sell up to $300 million worth of stock. At the same time, its preliminary net sales in the fourth quarter, about $1.2 billion. Its comp sales, you ready for this? Down 40 to 50% in the fourth quarter, a 40 to 50% drop in the fourth quarter in those comp sales. Now, analysts were looking for a drop of about 26%, but obviously this is worse than that. And the company's, those fourth quarter net sales, by the way, the preliminary number of $1.2 billion that I mentioned is versus estimates of about $1.43 billion. So, Brad, the struggles continue for this retailer.
Yeah, struggling to move through inventory, struggling to keep stores open. The list of store closings just continues to climb. As of right now, based on the company's own kind of size 8 font, it's about 4 pages long, and it just continuously fills up or adds on. And it continues to get updated monthly almost. It's updated most recently as of February 7th. You imagine with enough of the kind of profit margin squeeze that continues to ultimately impact this company and the recovery that they're trying to chart, it's just a larger question of, okay, for anybody who's looking at this stock and still trying to evaluate whether there's an opportunity in this, there's a miracle that's going to have to happen, quite frankly.
Yeah, I mean, it takes retailers a long time to die, unfortunately. I mean, we saw that with the likes of Kmart and Sears, exactly. Yeah. Those are the prime examples that I think of, and this seems to be another example of that, very unfortunately, for the folks working for that company. And also a lot of fans of it out there who have been traditionally. There's the opening bell on this Thursday morning here. IR Magazine ringing the opening bell here this morning as we are setting up following the day in which the Nasdaq 100 regained a bull market, right? Rose 20% from the lows, its last low on December 28th. It's now up 20% since then. The Nasdaq Composite not quite there. As our Jared Blickley pointed out earlier, there's a gap in the Nasdaq Composite performance, and the Nasdaq Composite is the one that you see there on the screen versus the Nasdaq 100. But nonetheless, we've got all three majors rallying once again in today's session. Our market check here sponsored by Tasty Trade. And Brad, as we open up here, what are you seeing in the charts?
Yeah, setting the mood with some candlesticks for these past 4 days there. You're seeing it up by about 2% for the Dow Jones Industrial Average. Out of the gate, higher by about 0.5% this morning, though. The Nasdaq Composite, the aforementioned Nasdaq 100 bull market territory and run there that we've seen, and the Nasdaq Composite holistically, you're seeing that up over the past 4 days by about 1.5%. Just about 0.7% is what that, well, 0.7% in terms of a move higher this morning is what we're seeing. And the S&P 500, that up 0.6% this morning, past 4 days up by a little more than 2%. Let's take a look at the sector activity out of the gate this morning, and I'm just going to toggle back on over to that screen here so we can take a look at the 11 S&P 500 sectors. Technology, and this is year to date, but if we put this on intraday, you're going to see XLRE actually leading the pack as all of the major averages or all of the major averages and their sectors as well for the S&P 500 are in positive territory. Real estate leading the charts, that's up 1.3%. And then additionally, you've got a sea of green there on the rest of the sectors. Looks like XLB as well. Materials doing well this morning. That's up by about 1%. And technology and consumer discretionary, a little bit of flip-flop there on a percentage basis, but both of them in the green by about 0.8% right now. Let's also just take a quick look at the Nasdaq 100 tech-heavy average. Been a lot of focus on tech, and for good reason, because of course the year-to-date activity that you've seen within tech, especially for those mega cap tech stocks, large bounce back there, especially in names like Nvidia. You're seeing Tesla and Meta even up. Meta's up by about 70% this year. Intraday, you're seeing some slight declines here in Meta platforms. It's down by about 0.3%. Nvidia, though, you've got some good chip news more broadly in that industry that has come out. So Nvidia, perhaps one of the beneficiaries on that news from Intel, and then additionally, we're tracking Tesla and Amazon. They've got gains of a little more than 1.3% right now. Microsoft, hey, that's up by about 1.3% right now for the Washington-based company.
Yeah, and as we can see, because this is a market cap weighted heat map that we have here, Apple and Microsoft remain just absolutely dominant in terms of their weighting in the Nasdaq 100. And as Jared pointed out earlier, it's really the mega caps that are responsible for the outperformance of the Nasdaq 100 versus the composite this year. It's just been amazing, the growth that they have had as others have fallen back the year to date. Oof. All right, let's take a look at some other movers here. We got Roku. It's looking to further trim its headcount. It's got a second round of job cuts happening right now. This time announcing it is laying off 6% of its workforce. The shares are trading higher here. So this is a restructuring plan. It seems like it is more than just the cutting of headcount here. They're also going to decrease their office footprint, right? And that continues in the line of what we've been hearing recently from a lot of different companies. The company says an unspecified amount of unused office space, they're going to vacate it, they're going to sublet it out, and will save money as a result of this. It's going to have some severance costs as a result of these layoffs of $30 to $35 million, but then in the longer term aims to save some money with these moves.
Yeah, and this really ties back to that advertising division and the revenue that they're able to see come into it from advertising and their efforts there. Of course, typically a very high margin and profitable business. However, for the broader ad market, I kind of harken back to one of the reports that had come out earlier this week, or at least a study from Magna and their forecast. They're still projecting growth, 3.4% ad growth, but that is lower than their prior forecast, and this affects a range of companies, can affect anyone from Roku to even a Netflix ad-supported tier, all the way into the social media companies as well. And so that, for the broader ad market, could potentially be a headwind that they are facing in the near term. But for Roku, this comes, as you mentioned, as they had already made some significant workforce reductions prior to this, as well as the rest of the tech space as well.
Yeah, although the stock's up 57% this year and got upgraded by Susquehanna earlier in the week, so that did not hurt matters. Speaking of analyst calls, let's talk about a Morgan Stanley call. It's downgrading Charles Schwab from overweight to equal weight. As the analyst says, clients are moving cash out of the firm's low interest rate bank accounts at twice the rate that Morgan Stanley expected. And this is interesting here. You know, we perhaps haven't talked enough about Charles Schwab amidst this banking crisis because it's been one of the companies that has really been under scrutiny here and has been hit amidst all of this going on. Charles Schwab has come out and said, our liquidity is fine. We're doing okay. But nonetheless, something that the Morgan Stanley analyst is zeroing in on here is that we are seeing client money moving into money market funds. $20 billion a month is the rate at which that is happening. Now, it's not going away from Charles Schwab entirely. I think that's important. But it is moving around into different type of instruments.
Yeah, within this report, in this note, rather, they said that the investment thesis has been pushed out, and we have less confidence around the timing of an improvement. And for Charles Schwab, you've been keeping an eye on the shares over the past year, yeah, down by about 40%, but a lot of that drop really taking place here in recent weeks as well. So for shares of SCHW, it seems that just another bearish call here on the street as the stock is down by about 30% month to date. Does not come at a great time for them, and so we'll see exactly where the rest of the analysts and those calls continue to line up at as well. Also want to talk about another call here on the street, Walmart receiving a rating upgrade from Evercore ISI, the firm bumping its rating on the retail giant from inline to outperform, citing Walmart's traffic and margins positioned for upside over the next 2 years. Taking a look at shares here on the day for WMT, you're seeing them up by about 1.5%. And I think there are a few trends and quite economically cyclical that you can point to within Walmart as well. And it's how the consumer engages with a brand like Walmart, whether that be on the grocery division or just some of the other discretionary divisions where Walmart has had to adjust some of its own inventory levels and be able to navigate this near term. But there's still this type of mindset or spending reversion that Walmart is a beneficiary of in times where there is more economic pressure, where consumers will say, okay, yeah, I'll just go get everything from Walmart or use that as my own kind of discretionary spending hedge as well. I do this myself. They've got great golf shorts for like $16.
Yeah, though it's interesting here. This call seems to have less to do with the macro environment and more to do with the work that the management has done. And the first line of it is, it's time, of this note from Greg Mellick, that basically he says, quote, management's diligent work to pivot the business to omni-channel, divest non-core assets, and invest in productivity has positioned traffic and margins for upside over the next 2 years. And he is talking about consumers making what he calls wallet allocation choices. So there is that. But I think the call here is that management has well positioned the company to take advantage of that. It's not just sort of the secular Walmart idea, but that there are some specific things that they've been doing, which is kind of interesting here. They also talk about strength in Sam's Club in particular, that company has been building momentum, and that the international portfolio is relatively strong as well.
Yeah, in terms of cyclical defensiveness as well. In 2007, they said they remember buying all the Walmart that they wanted at 14x just before the stock outperformed and re-rated to a big premium versus the S&P 500. So that part of their bullish sentiment that they have appended to Walmart here on the day, and shares reacting. And we're also watching shares of RH, after the company warned of challenges ahead for the next several quarters as it battles with a slowing housing market and banking turmoil. We're going to break down those numbers actually with an analyst from Wedbush a little bit later on in the show. You're taking a look at shares of RH, though, down by about 1.1% right now. And coming up, why the growth of artificial intelligence may be the key to a turnaround for the semiconductor industry. Yahoo Finance's own Dan Howley's got the details next. As companies look to capitalize on the growth in artificial intelligence, one sector that might be poised for a turnaround is semiconductors. Yahoo Finance's Dan Howley joins us with the details. Dan, what do we need to know?
That's right, Brad. We're talking specifically about Micron here. And during their recent earnings call, the CEO essentially said that, look, AI could prove to be a big boon for the semiconductor industry, specifically on the memory front. Obviously, Micron is a big memory company. And so the need for more memory chips inside of these servers, the vast amount of memory that's required to run these kinds of applications, could help provide a boost for an industry that's ailing at this point, quite frankly. We had the explosion of purchases during the pandemic, and then just as we saw on the consumer side of things, which Micron also deals in, people started pulling back on spending. They had done all their purchasing and they didn't necessarily need to buy on the consumer side. And then on the enterprise side, well, interest rates started rising, and so they definitely wanted to pull back at that point, not to mention inflation. And so we saw a big pullback there. But now with the rise of AI, this could provide a kind of boost, light a fire underneath the industry to get people to start buying. And it's not just Micron, by the way. We've seen other companies that are really kind of benefiting from this discussion around AI, specifically generative AI. NVIDIA, obviously one of the big beneficiaries, they happen to have their GTC developer conference, and that was one of the biggest announcements there was the different developments that they have going around generative AI and AI in general. And so you look at NVIDIA, one of their biggest rivals, AMD, they also provide graphics chips, and then Intel as well. They have the CPUs, AMD as well. And just because graphics is great at accelerating the process processes doesn't mean they don't need CPUs to help run those servers. And Intel could be a beast there as well. So, this could kind of help raise all boats at a time when, the semiconductor industry is really ailing.
And it's interesting. I think I saw one commentary from an analyst on Intel's announcement in particular that it's like the stock went up a lot in part because things have been so bad. In other words, it's not like maybe they should be enthusiastic about this announcement, but it's also all relative given kind of what's been happening in Intel, with Intel specifically and with the sector more broadly.
Yeah, with their new chip that they had announced coming to servers earlier than was originally expected. Yeah, that's kind of the same kind of discussion that, frankly, I think has been had around Facebook as well, or excuse me, Meta, where they were such beaten down stocks in the tech sector that you figure, well, I guess they have to go up again, right? And so yeah, that's part of the discussion with Intel for sure. I mean, look, they've basically had their lunch stolen from them by the schoolyard bullies. I mean, TSMC able to put together better chips, more advanced chips. AMD stole market share. NVIDIA basically boxed them out of the GPU space that they, fairly weren't in, but are trying to get into. And so, you have to figure at some point there's got to be good news for Intel around the corner. And this new server chip that's coming out earlier than expected could be that. And don't forget, they're in the midst of a multi-billion-dollar turnaround plan here where they want to be a better fabricator. They call them fab. They're building fabs across the country. The big facility out in Ohio. And then, they're also trying to not necessarily beat TSMC as far as the nanometer on chips, but the performance per watt. They're talking more about performance than nanometers, but the industry focuses on nanometers, and that seems to be what a lot of Wall Street focuses on. So we'll just have to see where Intel lands at this point. But, they are trying to turn things around. And, you got to look, this is a decades-old company, a stalwart in the chip space. They've got to have something up their sleeves with CEO Pat Gelsinger.
Dan, I was looking through the presentation that they had put forward in the webcast yesterday for Intel, and they had some rave reviews from AI companies like Hugging Face, which, interesting name, Josh Wolf, who spoke with us at South by Southwest from Lux Capital, he had mentioned Hugging Face. And so if he is validating that and Intel is validating Hugging Face, no doubt great thing for Hugging Face. But what does that mean for Intel's play within AI? Are they a net beneficiary of this AI wave as well?
Yeah, I think, frankly, any of the semiconductor firms will benefit from the wave of AI. Now, I think here's the main thing, right, is they have to make sure that it's not a fad and it's a trend, right? Generative AI is super big right now because of ChatGPT, blew up. Microsoft jumped on that. They were already invested in OpenAI, but they realized that they had momentum, and so they're working it across their product portfolio. We have firms like Hugging Face and others that are diving in or have been in the generative AI or AI space. But generative AI is really the big popular phrase right now, I would say. They have to make sure that it's not just a fad, that it's not Web3 or NFTs or the Metaverse, which at this point is seemingly just a fad, right? I do think that, generative AI and AI, obviously, in general, they have the benefit of having tangential, benefits. I'll just use the word again, because they do provide services to consumers and businesses that the other, platforms don't. NFTs, Web3, Metaverse, all those kind of, terms that everybody used and threw out there. AI provides you with a service that's needed. It speeds up different processes in companies. It offers new capabilities. So I don't think it's going to be considered a fad or just this short-term burst. But, I think the huge push into it as far as generative AI goes is getting a little fatty at this point, just because every other email I get is generative AI, generative AI. It's like, you guys, Snapple has, I wrote about this a few weeks ago, Snapple has a generative AI Snapple fax that you can get online. So it's like, okay,
of course,
there are true purposes for this technology. and then there's Snapple. So I do think it will benefit the industry overall.
Well, I mean, this is what would happen with the metaverse as well. So your point is really well taken. Is it a fad or is it a trend? By the way, we're going to pick up on that theme a little bit later in the show when we talk to Scott Kessler. Thanks so much, Dan. Appreciate it. That's later with Scott Kessler. But coming up next, we're going to speak with Maryland Senator Chris Van Hollen on what's to come as banking turmoil eases and Congress turns its attention to what to do in terms of regulation. That's next. Continuing to break down the fallout of the current banking crisis, what are the next steps that lawmakers are taking to make sure this does not happen to other banks in the future? Senator Chris Van Hollen, Democrat of Maryland, is joining us now to discuss. Senator, thank you so much for being with us, first of all. Obviously, you guys have been paying attention to this. There were hearings earlier this week to try to figure out what next steps are. What is your sort of initial thinking here as to what Congress needs to do?
Well, it's great to be with you. And I think we had a very informative hearing, but I also think we need to dig even more deeply as we go. The one area where there's emerging bipartisan consensus is that we need to expand the authorities of federal regulators like the FDIC to claw back compensation taken by CEOs and top executives whose own negligence contributed to the meltdown of a bank like Silicon Valley Bank. As you know, under Dodd-Frank, there are provisions that allow the clawback of compensation proceeds from stock sales when it comes to the biggest banks. But there are some loopholes with respect to banks that are under that, not so big. So there is bipartisan consensus that we've got to do that. And of course, one of the hopes of doing that is it would deter riskier behavior if some of the decision makers knew that their own stock proceeds, sales, in the case, for example, of the SVB CEO who sold 3.6 million in company stock 10 days out, that would have some deterrent effect on excessive risk taking.
Senator, we do know that the FDIC is now considering making sure that in order to shore up the insurance fund, that some of the largest banks are actually paying a higher portion than they currently are into that fund. What is your perspective on that, and how should the banks be stepping up to ensure that at the end of the day, the broader system is more secure?
Well, I think it's appropriate to ask the biggest banks to contribute more to the overall insurance of the system. But this is a part of the ongoing conversation here. And, part of the conversation is what needs to be done legislatively. The other part of the conversation is, what can we push the feds and the other regulators to do to be able to better detect and react to the kind of situations we saw at SVB. One of the things we've learned is that they were on to some of the problems at SVB. And then the question is, what options did they have to act before the final meltdown? Could they have exercised some of those options earlier? Or do you have to wait until, a crisis hits? I do think that they moved very quickly, and I think they moved effectively once there was a crisis. But what more could we have done earlier when they detected signs of problems to react to prevent it from getting to a crisis point?
Senator, I'm always curious to hear what members of Congress are hearing from their constituents. So I would ask you that in this situation. And obviously, in this case, your constituents include both banks that are based in the state of Maryland, as well as individuals and businesses who have their money at banks. And so I'm curious what you're hearing from them on sort of both sides of that.
Well, one of the things we hear from constituents all the time is no bailouts for banks whose own negligence caused their problems. And as you well know, the Biden administration did not provide any bailout to Silicon Valley Bank or their investors or anybody else who had a stake in the bank. So,
and do you think do you think that people understand that? Do you think people are, have sort of grasped that it wasn't a bailout, or do they still have questions about that?
I think there's some remaining questions about it, and part of that question relates to this issue of again clawing back compensation, because while there was no bailout of the investors, we all know that, for example, the CEO took that big stock sale proceeds 10 days out. And so I think sometimes people see that and they think somehow, they got bailed out. The bank did not get bailed out. The investors did not get bailed out. But this is why it really is important that we find ways to claw back proceeds, because people who are responsible for decisions that collapsed a bank should not be able to, make profits or get compensation from that bank, certainly not in close proximity to the time that it went under and had to be taken over by the FDIC. But so you're right, we're having to make clear this is not 2008 when there was a bailout of the banks. This is a very different response.
In the wake of this banking turmoil, though, are there specific either checks or stress tests even, or any type of reporting that lawmakers are considering adding on to the current kind of framework that banks have to adhere to in order to make sure that we avoid this in the future?
Well, yes. Look, I'm one of those who believes it was a mistake to, roll back the part of the Dodd-Frank oversight provisions, the stricter scrutiny provisions that applied to a bank the size of SVB. I still think that could be a contributing factor to what happened. But in the meantime, as we talk about legislatively trying to plug that hole or fix things, we are asking the Federal Reserve and the regulators of the Federal Reserve to maximize their existing authority, even under that amended version of Dodd-Frank, because they do have the authority to do even more than they were. So many of us are pushing them to do that. I will say there's there's a little bit of Monday morning quarterbacking. I got a lot of my colleagues on the Senate Banking Committee and a lot on the Republican side who in the weeks and months leading up to this collapse were actually pushing the Federal Reserve to lay off, to not be such tough regulators. The good news is now, they're no longer calling for greater relaxation, but they're pointing their fingers at the same folks that they asked to back off. In this case, we're still getting all the details about what what was known by the regulators and what was not. And I think based on that further information, we'll be able to maybe come up with another legislative package. But again, for now, the bipartisan consensus revolves around the compensation clawback provisions.
Senator, I want to, if I could, turn to another issue of great importance to the markets here, besides what's going on with the banks, and that's the debt ceiling. And there doesn't seem to be a lot of bipartisan consensus, does there? I mean, what message would you have for market participants and Americans, for that matter, at this point about, how long we're going to be seeing this debate, whether Washington can come to agreement on this?
Well, you're absolutely right. That's a great concern that I share. And the sad part about this is there is a very simple fix, which is we could vote today to make sure that the United States preserves its full faith and credit. It'd be a simple vote. You could even do it in a way that gives the president the authority to raise the debt ceiling, subject to a congressional override, something that Senator Mitch McConnell has proposed and we've implemented in the past. The problem is pretty straightforward. You have the Republican-controlled House refusing to pass the law to make sure that we preserve our full faith and credit. And instead, they've taken the position that we've got to adopt their very, in my view, right-wing radical proposals as the price that we pay to make sure that the country pays its bills on time. Well, that's just not the way it works. These are not Republican bills. They're not Democratic bills. They're Uncle Sam's bills. We are more than happy to have a conversation over budget issues. And in fact, President Biden submitted his budget plan. It's got $3 trillion in deficit reduction over 10 years. So we're asking House Republicans to put their plan on the table, put their budget plan on the table. We've not seen it because we don't think they've been able to get a majority together to support any particular proposal. So, put your plan on the table, but let's not threaten that the United States won't pay its bills on time. That would have catastrophic economic consequences.
And then finally, if I can turn to one more issue that I really want to get your view on, Senator, and that's the issue of gun control. We just heard the president say he has come to sort of the limits of his powers as executive to implement changes on gun control, sort of putting it back to Congress. Have we lost in this country on gun control? Is that it? Is this just what it's going to be?
I think it's absolutely shameful that we haven't been able to muster the votes to pass more comprehensive common sense gun safety laws in the United States of America. You look around the world, and when it comes to these continuous mass shootings and even the daily toll of gun violence, we're uniquely bad. And so it's pretty clear that we need more national gun safety laws. But unfortunately, as the president has said, we don't have the votes. I'd like to take up the bill and pass the ban on semi-automatic assault weapons. We had that in place for 10 years. In our country. It lapsed under President George W. Bush, but we need to renew that bill. There are other things we can do to close big loopholes when it comes to gun sales in parts of the country.
But it doesn't sound, we can do a lot, but it doesn't sound like anything is actually going to happen.
Well, I guess my point is right. I mean, what is just so angry, what makes me angry about this, right, is because we do have these options. We can do things to make things safer, but we also live in a country where we're a democracy. We don't have the votes. So you ask what people can do, they need to make this a issue when they go to the ballot box. Because if you agree that we need more comprehensive national gun safety laws to better protect our people and protect public safety and kids, then you need to vote for people who are willing to do that, because all it does come down to votes. So when President Biden says to Congress, pass this, I agree with him, but you need the votes to pass it. You need a majority to pass it. And we do not have the votes in the House or Senate to do that right now. So we really need for this to be a voting issue for the American public.
Well, we'll see if that happens the next time around. Maryland Senator Chris Van Hollen, thank you so much for spending some time with us this morning. We appreciate it.
Thank you.
And as we take a breath here, let's take a look at a trending ticker that we're watching this morning. That is Manchester United. The English football giant has turned a profit for the first time since the pandemic took hold, posting a 22% jump in commercial revenue, but its income from match days and broadcast slipped. The club, of course, is currently the subject of a takeover battle, and it saw its debt rise in the quarter, saying it still owes around $650 million. Despite all the buyout talk, Man U did not mention anything regarding a sale. Any update on that? Well, Binance appears to be the focus for crypto watchers amid a CFTC crackdown. Our colleague Rochelle Akufo, spoke with former FTX spokesperson Kevin O'Leary on the sector and fears that Binance and founder CZ could be the next shoe to drop.
I think it's game over, checkmate for CZ, and it's only a matter of time till there's a run on that BNB token, $64 billion. Now, either the Chinese government is backing that token or they're not. But if there's a run on that, it's sayonara CZ.
Well, Rochelle is going to be diving into Binance and the entire crypto industry later this morning. Obviously, he was quite outspoken on that and a lot of other stuff. But what can we expect to hear from your show this morning?
Well, it's interesting because we're going to have some guests who are going to be coming up looking at some of the repercussions here. Obviously, the CFTC suing the world's largest centralized digital asset platform, Binance. Now, they're alleging that CEO CZ and his former compliance chief violated trading and derivatives laws, claiming the company has an ineffective compliance program. Now, CZ has disagreed with the characterization of this on his blog post, but we did see Bitcoin fall alongside some other tokens on the news. It did recover, but investors pulled about $1.6 billion out of Binance in the 72 hours following that CFTC announcement. That's according to blockchain data tracker Nansen. So we're going to be taking a look at that and the broader impact because a lot of crypto investors are wondering about the next shoe to drop. So we'll be diving into that.
And so this is happening while regulators for traditional banks, they're dealing with their own fallout right now. So kind of pair the two together for us.
Well, that is one of the issues that we're going to be talking about. Scott Melker, who's host of the Wolf of Wall Street podcast, he called out this irony, tweeting that regulators are busy fighting crypto while their own properly regulated system is collapsing around them. Now, Scott is one of the people joining me in the 11 a.m. show, alongside Axios crypto reporter Brady Dale, looking at the next exchanges to watch, including, of course, Coinbase, given the size of its market share, where investors are moving their crypto, also looking at how to walk that line when you have the two primary regulatory bodies overseeing crypto, blurring the lines on how it's classified. You have the SEC, the vast majority of crypto, excluding Bitcoin though, considered a security based on the Howey test. The CFTC seeing crypto as a commodity. So a different set of regulatory and legal requirements for each. And just to note that the lawsuit with Binance is a civil one, not a criminal one, as in the case with FTX and Sam Bankman-Fried, facing his 13th indictment today in federal court in Manhattan.
Right, he's going to be in court again at 11 a.m.?
Yes.
Yeah. Well,
just
we'll
in
look
time
for the headlines, just in time for the show. Exactly.
All right, going to see that floofy hair somewhere. Rochelle Akufo, thanks so much for joining us this morning. Got a lot to look forward to at 11 a.m. with Rochelle. And coming up, everyone, why our next guest says the latest economic data is signaling no easy way out for the Fed. We'll speak with Macquarie Group's David Doyle. That's next.
Welcome back to Yahoo Finance Live. I'm Julie Hyman with Brad Smith. Let's take a quick look at the market action here as investors digest. We've had initial jobless claims this morning. We had another read on GDP, and we have anticipation of PCE tomorrow. All of that is equaling a little bit of a lift in the markets today. The Nasdaq Composite up about 2/3 as we told you. The Nasdaq 100 re-entering a bull market here as we have all three major averages up on the year. I'm taking a look at some of the trending tickers here. We have some interesting individual corporate stories that we have been keeping an eye on here today. Intel shares continue to move higher. As we told you yesterday, they introduced a new chip. They've been sort of bouncing back along with the broader chip sector. They're up another 2% today. And if you look at the year-to-date action, really we've seen an upsurge in the past couple of weeks or so for Intel. Let's look at RH on the other hand. We're going to be talking more about RH with an analyst in a little bit, but the company came out with earnings that disappointed and the shares off just a little bit. They've been kind of bouncing around a lot. In the pre-market, were down more. Then they went slightly positive, so that's one we're watching as well. Bed Bath & Beyond announcing a new $300 million or filing to sell $300 million in shares to raise capital after saying its preliminary fourth quarter comps went down by 40 to 50%. Those shares down 7% today. Watching those. And one other I wanted to bring your attention to, and that's a company called Sprinkler. Sprinkler without the E. It is a software company that came out with earnings, and the shares are up some 16% today. They are up 54% year to date. Brad, that's in line with a lot of strength that we have seen in software that you highlighted earlier in the show.
I was a Sprinkler power user and admin in a past life.
Wow. Yeah. I've never heard those words used together, but kudos to you.
And we also got to talk about some economic data. The U.S. GDP increased at an annual rate of 2.6% in the fourth quarter of 2022. That figure is adjusted for inflation, or known as real GDP. The reading comes ahead of the Fed's preferred inflation gauge tomorrow. That's core PCE. All of this coming as bond king Jeffrey Gundlach warned earlier this week it's only a matter of months before the U.S. tips into a recession. Here to discuss the state of the U.S. economy is David Doyle, Macquarie Group Head of Economics. David, it seemed like it's been only a matter of months until we tip into a recession for several months, if not a full year now at this point. So, if it does and when it does happen, how shallow, mild, severe a recession should we be bracing for now that the calls are getting a little bit louder?
Yeah, so our view has been for some time that you will confront a recession in 2023. It looked like late last year that it could occur at the start of the year, so in the first quarter, but the data inflected higher over January and February, and we saw some improvement. So our current baseline is that you'll enter a recession in the third quarter of 2023. We suspect that will be about a 1.5% peak to trough contraction in real GDP over the course of about 4 quarters or so. That's about equivalent to what occurred in the 1990-91 episode. So I would call it a true recession, but something that's not quite as severe as we saw in, for example, 2008, 2009, where real GDP contracted by more than 3%, and it occurred over the course of a year and a half.
As our Miles Udland wrote in this morning's morning brief, David, and sort of as Brad alluded to, we've seen this recession coming for 6 months for the past year, or for the past 9 months. In other words, it's, and as you said, you predicted it before. This has been broadly forecast, right? Does that have any implications for the type of recession it could be? In other words, is there danger of talking ourselves into a recession? Or on the flip side, do we mitigate the recession by expecting it so much?
Yeah, well, certainly there's heightened expectations, I would say, this time around for a recession. And it's possible that, folks like myself that are out there talking about the potential recession are part of what causes the recession to occur. There certainly is a lot of psychology that goes into these things. We've seen weakness broadly across the data. So here at Macquarie, we have a suite of leading indicators that we follow and track that give us a gauge or a guide as to whether or not we should be fearful of recession. Those started to signal that a recession could be potentially on the horizon in April of last year, but it looked at that point that it would be, at least 9 to 12 months away. And what's happened is that what we haven't seen yet is the spillover into the labor market that has historically occurred at this point in time. We still suspect that it's on the horizon, that it's coming. You still see signs of that beneath the surface in the labor market data. But there's still a range of outcomes, right? So it could be that the recession that we're looking for starts in the second quarter. It could be in the fourth quarter. But our base case right now is the third quarter of 2023, and that's where the data in aggregate point us towards as being the most likely starting point.
Well, but wouldn't that assume that you see not only within the employment situation, not only a wave of even more headcount reductions across companies and across industries, but on the other side, a wave of the open positions also being retracted at the same time, because that would be the true tightening there on the employment situation front.
Yeah, so it's layoffs, it's a deterioration in corporate hiring. I'm sure we've seen some moderation in the job openings data. Some of the private sector data shows a greater moderation than what you would get from the government's JOLTS report, for example. But we see it beneath the surface in the data. So one thing that we look for is, has unemployment bottomed or has unemployment dropped? And it's been a couple of months now since we've seen the unemployment rate on a smooth basis reach a new low. That's typically a warning sign that a recession is on the horizon. The insured unemployment rate, which is calculated off of the continuing jobless claims numbers, which come out weekly, that's showing a tick up of about 0.3 percentage points, again, on a smooth basis from its trough. So I think you are seeing signs of a softening on the labor side. It just might take a couple more months before we see it truly apparent in that headline data.
We'll be watching for it. David Doyle, thank you so much. Macquarie Group Head of Economics. Well, we're watching a trending ticker right now. That is Block. It's responding to investor questions stemming from the allegations in Hindenburg, the short seller's scathing report. Jack Dorsey's company, the company he runs, addresses the most frequently asked investor questions, most of which relate to how Block measures Cash App transacting active users and the company's compliance program. This comes after Block fired back on the Hindenburg report, calling it, quote, inaccurate and misleading, while also looking to explore legal action against the short seller. So that was sort of phase one. This FAQ is sort of phase two. And Brad, those shares are trading up by about 4% here today. Yeah,
I was reading through this a little bit before the show, just about 3 pages of those FAQs, and ultimately many of them addressing what the allegations were from Hindenburg research. And particularly one that I did zero in on was the 51 million monthly transacting users that they spoke about, and saying that of these, approximately 44 million were connected to an identity verified program that they go through. And so ultimately, approximately 13% of the unverified accounts as of December 2022, they've completed that identity verification program so far in 2023 as the date of this release as well here.
Yeah, interesting stuff. We'll continue to track it and see what the back and forth looks like. Coming up, Lamborghini revving up its push into EVs. We're going to speak with the company's chairman and CEO next. We are 50 minutes into the trading session. Let's do a quick check of the market, sponsored by Tasty Trade. We've got stocks hanging on to the gains here. The Dow, the weakest link of the three today, as it has been really for the past several sessions, up just about 1/5%. The S&P up almost 0.5%. The Nasdaq gaining 0.6%, and real estate continues to be the best performing sector in the S&P 500. Interesting, given all of the chatter recently about commercial real estate in particular.
All right, well, everybody wants to know when Lamborghini, looking to mix things up. The Italian supercar brand unveiling its first ever plug-in hybrid supercar, the Revuelto, as automakers shift their lineups to embrace electric vehicles. Here with more, Lamborghini chairman and CEO, Stefan Winkelmann, and Yahoo Finance's own Pras Subramanian. Great to have you both here with us today. First and foremost, we got to know, for Lamborghini, what really spurred this move into what is, I guess, leaning more EV than hybrid at this point?
But first of all, when we do hybrid cars, and this is starting now with the Lamborghini Revuelto, there's one clear promise we are giving to our customers, and that this generation is better performing than the generation before. But on top of that, it has to be much more sustainable. These are the two promises we have to keep. We cannot do one without the other. And then this is the start of our strategy. In the next couple of years, we will hybridize all of our lineup. It's the right moment to do so, not only because of the legislation, but also because this is giving a boost in terms of performance together with sustainability, and our customers are demanding both of them.
Hey, Stefan, so this is Pras here. So the car combines a V12 engine with 3 electric motors. You said it combines what customers want in terms of emotion, but also with reducing emissions, like you said. What has been the customer response so far for this vehicle?
We presented the car yesterday as a world premiere. We had a lot of customers from all around the globe, and the reception was phenomenal. Everybody was trying to put an order in. I have to say that already in the last weeks and months, we had, let's say, sneak previews, like we call them. And we have already the next couple of years of production covered with orders. We will start production in the second part of this year, and we will start deliveries by the end of the year 2023.
So Stefan, the car can go, I think, 10 kilometers in pure EV motor, around 6.2 miles. Is this a target that you guys had internally, or is it a regulatory thing that the EU wanted you guys to do to have a car with EV power?
But it's part of our global strategy. First going hybrid in the next couple of years. So the entire lineup will be hybridized by the end of 2024 in order to reduce the CO2 emissions in comparison of today by at least 50%. This is the first step. This is, let's say, a multi-layer approach, because it's not only because the legislator globally is demanding more and more a reduction of emissions, but we also have to manage to do those things by keeping in mind that performance is to the utmost performance, because these are cars which are not meant to drive from A to B on a daily basis, but these are cars which have to fulfill the dreams of our customers, and therefore it's important that we keep this dream alive, and therefore the combination has to be perfect.
Stefan, you can bet your bottom dollar I can't wait till I can drive my Lambo to and from the grocery store one day in the future, and for it to make sense. You know, ultimately, when I am able to place that order one day, a lot of people who are placing those orders are wondering what that delivery timeline is like. Have you seen any variation in just the ability to fulfill orders right now?
In the last couple of years, so right after the first shutdown of COVID, globally, let's say the market was coming back much quicker and sooner than expected. And we are having an incredible run already starting from the year 2021. 2022 was another record year in terms of not only deliveries, but also in terms of profit for our company. And we have an order bank which is lasting between 18 and 24 months. I think this is more than solid. It's something which in the high-end industry is something which should be normal. I think if we can come down to between 12 and 18 months, it would be even better. We are working on it. We increased production in the last couple of years. But for us, let's say, the waiting time is also a signal of how much the brand is appreciated and also how much our products are valuable. Because if you want to buy a Lamborghini today, you find a used car. And usually the used car is at least on a new car sticker price, if not higher than that. So this is a good investment also, and not only a dream becoming true.
Stefan, it's Julie here. Looking far into the future for Lamborghini, given that it is a performance vehicle, given that it is a special, storied brand, do you see a time where Lamborghini will not be making gas-powered vehicles, gasoline-powered vehicles?
For sure. By the end of the decade, we are planning to have at least 2 cars to be full electric cars, so battery electric vehicles. This is by the end of the 20s, and which will help us to reduce the emissions further by up to 80% in comparison, the CO2 emissions in comparison of today. We are doing it first with those cars which are more the daily drivers, like our Urus, the SUV, and we are planning to have also a fourth model, which is going to be a GT car, so of 2+2. And we will keep, as long as possible, the 2 super sports cars, like we have seen at the beginning of our brand new Lamborghini Revuelto and the follow of the Lamborghini Huracan hybridized. We will see how the legislation and the homologation rules are going to move after 2030, and then we will decide accordingly.
Stefan, a quick follow-up here. We just saw recent legislation in the EU where an e-fuels carve-out was allowed for gas-powered cars beyond 2035. Does Lamborghini believe in e-fuels as a solution for keeping these V12s on the road?
I believe in harmonization globally of the regulations. For us, it's very important. We are a global company. We sell small volumes, but all around the globe. We have a very well-balanced distribution, about 1/3 in the Americas, 1/3 Europe, Middle East and Africa, and 1/3 Asia Pacific, more or less. And we cannot go with 2 different systems, so we need as much as possible an harmonization. And I see that synthetic fuel is going to be likely more for, let's say, ships and airplanes from the 30s. And I doubt that there will be a capillarity like it's today with the gas stations that will fulfill the needs of our customers. On the other side, all the manufacturers are investing in electric cars, in infrastructure, and more this is going to be, let's say, the new normal. And we have to adapt. We have to create a car, also electric cars. At least we have to be prepared also to do so, that are as emotional as the internal combustion engine cars we have today.
And Stefan, just lastly, while we have you here, the new normal in terms of this interior car experience as well has been touchscreens everywhere, just high touch capacities. For Lamborghini, is that something that you believe is going to be integrated into future models, even as people are paying, of course, high price tags, which to them might not be that much, but at the end of the day, looking at some of the rest of the technology out there, is that something that you're looking to incorporate into Lamborghini as well in terms of the technology and also what the number of chips would be necessary to also incorporate into the design if that were the case?
So it's clear that there are the 3 mega trends, no? But 2 are electrification and digitalization. Electrification we talked about, or sustainability in other words, and digitalization, or translated also software, is the other thing we have to heavily invest. And for sure, every customer is demanding something which every normal car in the future is going to have also in the super sports car. So we have to adapt our platforms, even if, let's say, the primary use of a Lamborghini is to enjoy the driving, but still we have to be up to date also in terms of digitalization of software.
Stefan, it's great to get some time with you this morning. Thank you so much. Lamborghini Chairman and CEO Stefan Winkelmann, thank you so much. And Pras Subramanian, you're going to stick around for just a second. Stefan, thank you. Well, turning to another story in autos, the Biden administration keeping up the drumbeat of electric vehicle news with new partnerships announced today and tax credit news set for tomorrow. Here with more is Pras. He's still sitting next to me. Pras, so set the scene for us here. What do we know now and what are we waiting to find out?
So today we just heard more about their public-private partnership they're doing with stuff like educating the public, building out the EV charger network on federal sites, and then also modernizing the federal fleet for EVs. So announcing partnerships with Amazon, Waymo, Siemens for charging, and even Hertz for consumer education. So that happened today. They're building out that whole sort of program. But the big thing is tomorrow, what everyone's waiting for is Treasury's guidance on the EV tax credits. Basically, there's battery restrictions and rules that need to be in place that Joe Manchin wanted very, very, very badly. Basically, they want the batteries to be built in North America and also have critical elements from trade partners or even US-based kind of producers. So once we hear that, that'll kind of tell us how many cars are going to be affected by that. So we already heard Tesla say, hey, they've told internally that their Model 3 reportedly will not qualify the base version because it uses a battery from China. So we'll see how this affects. And basically, if that's the case, you lose the entire tax credit. So we're going to hear more about that tomorrow. Maybe Treasury will be more lenient for the manufacturers or they'll be more strict. So that's a big deal. So tomorrow we should get that guidance.
All right.
Just real quick, like for people who've been waiting to buy an electric vehicle, because they're waiting to find out what this tax rate is going to be. Tomorrow they're going to get that information.
Well, they should buy now, because right now every EV is
it's going to get more restrictive as of
EV built
tomorrow.
in North America is good to go. So you got to get delivery by tomorrow.
Hurry up!
Yeah, exactly. There you go. Yeah.
Yahoo Finance's own Pras Subramanian, all things autos, and for quite the mega block here. Appreciate it, Pras. Coming up, tapping into the metaverse, why Meta insists that the virtual world is still the future. We'll discuss it next.
The consumer is resilient today. People are hopeful. And hopeful that they still can be prosperous in the future.
About 25 to 30% of your tenants are in fact tech, Meta and Amazon. These companies are cost cutting. They're laying people off. What are you seeing from those tenants looking into the second quarter?
We're actually seeing demand across the board, whether it be tech companies, financial institutions, consulting companies.
The impending recession we keep hearing is 6 months out.
What kind of trends are you guys seeing right now?
Still seeing good consumer demand out there. Question will be, how does that consumer hold up as we get to the back half of this year? But if we see that consumer hang in like they have through the first part of the year, we'll have the ability to bring production on and serve whatever needs are there.
This is still a very young market. You know, we're still talking about fractions of people and by the way, fractions of activity because of COVID.
Are you seeing any sort of deterioration in demand or differences in the decisions that people are making?
That's the flip side of this. There's some positivity for those who have some savings and investments, now can get a higher rate of return, even in FDIC insured deposits, right?
Yes.
With money markets and CDs like they've not seen in over 15 years.
But for the most part, growth stocks have benefited from the decrease in bond yields so far this year, according to research from Goldman Sachs and also according to our eyes. We have seen them go up. The investment bank, by the way, is now advising clients to hold on to high-margin growth stocks while steering clear of low-margin names. For more on this, we bring in Yahoo Finance's Inez Ferre for, what is high margin and what is low margin in this environment?
Yeah. Right. Okay. So let's step back for a second and basically talk about what Goldman Sachs said in this note. They're basically saying, look, we've seen progress when it comes to inflation. We've seen that the Fed has slowed down further. It's tightening. We have seen the real yields on the U.S. 10-year Treasury go down, and that has helped rally growth stocks. These are, think of the tech names that we've seen rallying. Okay. Well, Goldman is saying that looking ahead, it's recommending to own high margin versus low margin growth stocks. Why? Because they're saying that high margin growth stocks have outperformed low margin growth stocks by 5 percentage points since the recession fear sort of intensified earlier in March. And you can see a chart that they have also put forth showing how high growth, low margin stocks are more sensitive to real yields. So what is Goldman talking about when it's talking about high growth and high margins? Well, high growth meaning sales. They're looking at consensus forward 24-month sales growth, and they're looking at net profit margin expectations. So when they took a look at the stocks that they're saying, maybe you may want to choose these instead of these to hold on to, they looked at stocks within the Russell 3000, excluding biotech, excluding financials, excluding also energy stocks. It has to have a market cap of $1 billion or more and sales of more than 100 million or more. So they're looking at high growth, high margin stock. That means that 15% or more in sales growth and 15% or more in net profit margins. And we're going to show you a couple of charts of some of the stocks that they took a look at. And some of these include, as you would imagine, some of the software names, Palantir's in there, Workday's in there, Marvel Technology. You've got Airbnb, CrowdStrike, AMD, NVIDIA as well. By the way, NVIDIA up year to date 86%. And then taking a look at the high growth, low margin stocks. These are stocks that have 15% or more sales growth, but less than 5% of net profit margins, and in some cases, negative net profit margins. So you're looking at stocks like Luminar, Rocket Lab, Lucid, Plug Power, some of the EV players, DoorDash, Shake Shack, Riot Platforms, Roku, and also Uber is included in that list as well. So what they're saying is, look, if the economy enters a recession, the pricing of growth stocks is likely going to deteriorate, and it has been shown over time that investors reward quality attributes such as high margins, guys.
All right, Yahoo Finance Zone, Inez Ferre. Thanks so much, Inez, for that breakdown. Appreciate it. The Metaverse is losing its hype. Facebook's name change to Meta in 2021 created excitement and intrigue for the new frontier of the internet. But slow user adoption, costly hardware, and weakening economic conditions have sobered investors looking for meaningful revenue in the space. For more on what's next for the virtual reality headset pioneer, we welcome Third Bridge Global Sector Lead for Technology, Media, and Telecom, Scott Kessler. Scott, I should correct myself. They are in the headset space because they made an acquisition, but they really more so have been this social media platform over the years that's been able to make those strategic acquisitions in order to grow out their business and the number of realms that they operate in. But the reality is that realm just might not be the metaverse to the extent that they hoped everybody would flock to it.
Well, look, Brad, I mean, maybe not. And I think that's one of the big kind of issues is that when in fact Facebook indicated it was becoming Meta platforms, and you alluded to this about a year and a half ago, I think Mark Zuckerberg talked about this notion of potentially having 1 billion people in the metaverse within a decade. And I think a lot of people's reaction to that was, number one, I think at the time, Facebook and the other related properties had well over 3 billion users. And in addition to that, a decade out is a long time. So people, I think, started to ask questions about how much money are we talking about and what types of returns are we talking about and when are those going to be realized? So that's on one side. And then the other side is, of course, the environment that we're in now, where Meta Platforms has been championing this notion of the year of efficiency. And in the prior segment, it was referenced that NVIDIA is up substantially over the last year or so. Meta Platforms is up over 70% year to date, in part, I think, because of that perceived shift.
You know, and as part of the problem with the metaverse too, Scott, that it was never really well defined, right? Is it like you put a thing on your head and you're in this immersive world? Is it NVIDIA's sort of simulated world that companies use to train AI, for example? Is it Roblox where you're just playing a game? Like, what even is the metaverse? I think people sort of had a hard time getting their arms around it.
Yeah, I think that definitely is one of the issues, Julie. I also would say, going back to what I just referenced, I think just the kind of super long time frame where this was going to kind of gain critical mass is something that frankly puzzled people. And essentially they could have a situation where, I mean, you could be asleep for 5 years and maybe not miss anything. And I think that's kind of how people thought about this, right? Why not pursue the opportunities that are right in front of you, providing potential for quote unquote fast ROI, as opposed to, you know, something that might seem to some people like pie in the sky.
And so when we think about immersion and what that is for the metaverse, we had so often, because companies like Facebook had told us that this would possibly be the future, that there was going to need to be this headset or hardware technology that really aided this kind of optical sensory immersion that came through an Oculus or whatever the other virtual reality product was. But are we increasingly discovering that the metaverse may already exist, but just in a different form than we were pitched or sold based on another additive piece of technology?
Yeah, I mean, that's a possibility for sure. Honestly, I think one of the big kind of developments that is expected to occur this year is Apple getting into this AR/VR headset market. Tim Cook has said that Apple will in fact have a product in market this year. I would imagine that it could be, if not announced, it could be alluded to in a significant way at WWDC in June. But that could very well be a watershed moment for the metaverse and how people think about it. But for now, it does seem like it's kind of amorphous, and there are other opportunities that seem not just more near term, but more appealing.
And AI is certainly one of them, Scott. So I went in there because, as our tech reporter, Dan Halley, framed it earlier, we're all now trying to figure out if AI is a fad or a trend. I mean, metaverse, I guess we are not quite sure yet what that was. But like, as we look at all of this enthusiasm for AI, what's your read?
My read is that this seems to have more in the way of, I don't know, adoption and staying power. And the reason for that is because there are dollars in front of enterprises right now. So folks are spending, they're getting returns on investment. And if you think about the environment that we're in now, companies absolutely are prioritizing things like productivity and efficiency. You know, experts we talk to, for example, have indicated that when it comes to the enterprise chatbot market, that AI can handle about 30% of inquiries now. That could triple in short order. That essentially can make for very smart investments in related AI pretty appealing to a number of different companies in this space.
Good to catch up with you and talk about the metaverse that wasn't, I guess, at least not yet. Thanks for spending some time with us. Third Bridge Global Sector Leader for Technology, Media, and Telecom, Scott Kessler. Great to catch up with you this morning.
Thank you.
Coming up, Disney's first round of layoffs is underway. So we'll take a closer look at CEO Bob Iger's strategy coming up. We are watching shares of Disney this morning. Shares up a little more than 1%. The company's first round of layoffs are underway. Let's get a closer look at CEO Bob Iger's strategy ahead of Monday's shareholder meeting. Yahoo Finance's Ali Canal joins us. Now, shareholder meetings do tend to be a rather friendly affair, typically. I wonder what this one's going to be like and what he's going to say to them.
I know, me too. And this is very anticipated. Iger, he came back to the company end of November, and already he's enacted some pretty serious, layoffs at the company. You mentioned 7,000 jobs are going to be eliminated by this summer. That's going to happen in 3 rounds. The first round is underway this week. Second round will be the largest in April, and then the third round right before the summer. Now, as part of this first round happening this week, we saw Disney dissolve its Metaverse division, along with the exit of Isaac Perlmutter, who was the chairman of Marvel Entertainment. This is separate from Marvel Studios, Marvel Entertainment, responsible for consumer products, comic book publishing. So layoffs, a clear part of Iger's strategy. Bob Iger has stressed that he wants to get this company back on track. He wants to make sure that Disney Plus can hit its profitability target by 2024. And on the topic of streaming, Iger has made it clear that he is a fan of differentiated content, not general entertainment, which has suggested that Hulu might be on the chopping block. This is a clear turn from what we saw in the past when everyone largely thought Disney would buy out Comcast shares in Hulu. Disney currently owns 2/3 of the company, Comcast controlling the rest. But now it seems like Iger might want to do away with Hulu completely. Maguire analyst Tim Nolan was out with a new note this week saying that Hulu's future might actually be tied to ESPN's future and Iger's desire to make ESPN Plus a full over-the-top platform. So perhaps taking that money from a Hulu sale and dumping that into ESPN. Iger has made it clear that he is a fan of ESPN. He restructured the business into 3 different divisions: entertainment, ESPN, and parks. So when the next earnings reports come out, we will see subscriber numbers. We will see revenue for all those 3 divisions. So, a lot of questions on the table heading into this shareholder meeting, but so far investors seem confident in Bob Iger's plan. The stock is up more than 5% since he took over the company and up more than 12% year to date. So we'll see if Bob Iger can keep up this momentum, but Wall Street clearly loves him.
And then another kind of Disney surrounding story, the latest on Florida Governor Ron DeSantis' attempt to gain control of Walt Disney World's governing board in Florida. A little bit of a roadblock there.
Yeah, and we'll see if this comes up at the shareholder meeting. Iger hasn't really talked about this too much. He did briefly bring this up during an employee town hall in January, saying there's still more research he had to do since the drama of this all happened before he came to take over the company. However, there were several developments this week with the current oversight board. This was a board hand-selected by Florida Governor Ron DeSantis, accusing the previous board of passing a last-minute agreement with Disney that created a loophole to essentially strip them of their power. Now, this last-minute bill was signed February 8th, so just one day before this new committee was appointed, and transferred much of the power to Disney. There was a copy of this agreement published by the Orlando Sentinel, and according to the document, Disney can veto any major changes to the parks. It prohibits the board from using Disney's name or characters like Mickey Mouse without the corporation's approval. And it also invoked something called a Royal Lives Clause, which lives in perpetuity or until, quote, the death of the last survivor of the descendants of King Charles III, King of England, living as of the date of this declaration. This was an actual quote in the agreement. Now, Disney gave a statement to the Associated Press saying all agreements signed between Disney and the district were appropriate. Yahoo Finance did reach out to Florida Governor Ron DeSantis and Disney for comment, but is yet to hear back.
Did you reach out to King Charles for comment?
I should have. I should reach out to the royals, get them involved. I mean, what does this mean for them coming to Disney? Maybe they'll get some free passes. Who knows?
Maybe. Red carpet for sure.
Exactly.
Ali Canal, thanks so much for breaking down all things Disney for us here today. Also coming up, everyone, Restoration Hardware, RH, warning of challenging quarters still to come. We're going to speak with an analyst from Wedbush. That's coming up. Shares of RH are lower today after the luxury furniture company's CEO warned that business conditions would be challenging for the next several quarters due to housing market conditions and banking turmoil, setting its sales forecast far below estimates. Wedbush Securities Managing Director, Seth Basham joins us now. Seth, great to have you here with us. Help us break this down a little bit further. Just how long could these conditions persist?
Yeah, that's a good question. I think at least the first half of 2023 could extend into 2024, depending on what happens with the macro, and also depending on what happens with their strategy of quote unquote climbing up the luxury mountain.
And that's always what I'm curious about in these situations, Seth, right? You have on the one hand the macro environment, then you have the management of the company. The macro environment we know is not necessarily in their favor right now. What can they be doing to sort of manage their way through it?
Yeah, there are a couple things they could be doing. You know, they could be more aggressive in lowering prices and promoting their products to drive sales. There are a number of players in the industry, especially at the mass market level and to a certain extent at the aspirational luxury level, that are doing that. RH has decided that it doesn't want to play that game because it will negatively impact their brand. So they're restraining their promotional cadence. They are clearing a fair amount of merchandise to make room for newness and execute on their growth strategy, which is really all about expanding in Europe right now and introducing new higher end products.
Where is the material changeover in that merchandise strategy going to take place from your perspective?
Yeah, we're in the midst of it right now. Last year, they launched a new line called Contemporary, which has had mixed reviews thus far. They're launching a number of new collections within their core interiors and modern lines this year. And then we'll also see introductions in their outdoor set, which is happening right now. So a lot of newness with mostly higher prices, which could help drive average unit retail prices. But at the same time, it's a question of whether or not their core customer wants to pay those higher prices.
Well, and let's talk a little bit more about those higher prices, right? And about the consumer. I'm sure that you have been looking into sort of the health of that higher end consumer to some extent. What is the spending power right now, or the spending appetite, I guess, more appropriately? Because even if wealthier consumers have the money, maybe they're spending it on, I don't know, flying to the Riviera instead of buying an expensive new couch.
Yeah, I think it all depends on how you define the customer. If you're talking about that ultra high net worth customer, they might have a little bit less confidence to spend, but they have the spending power. So we saw RH's demand trends take a step back during the first 2 weeks after the banking crisis. They rebounded a bit, still down materially, but improved. But it's really that core aspirational luxury consumer that we see as moving more to the sidelines here. And that's a customer that has been key to RH's growth over the last 5 years, and a customer that they're de-emphasizing going forward to focus on that ultra high net worth customer. And to the extent that they de-emphasize that customer too much, they lose market share. And we're seeing that right now. It's a question of whether or not those market share losses are bearable or not.
Yeah, well, I guess we'll have to wait to find that out. Seth, thank you so much. Seth Basham, Wedbush Securities Managing Director, talking to us about RH. Let's get a final check on the markets here as we prepare to leave you. We've got the Dow, the S&P, and the Nasdaq all trading higher and really holding on to the gains throughout the day. Tomorrow morning, we got PCE. That's the next big thing to watch. But don't forget, you got to keep it right here to watch Rochelle Akufo for the next hour of trading. She's going to continue our market coverage. Charles Schwab's Kevin Gordon is going to be joining her in the next hour. It's always fun to catch up with Kevin, so we'll see what he thinks of the rally that we've seen, in particular in tech stocks. All right, we'll leave it there. Have a great one, everybody.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks pushing higher. The Nasdaq enters a bull market for the second time in almost 3 years as investors load up on tech stocks as a safe haven from the bank chaos. But are we really over all that? We'll discuss. And Binance is in focus for crypto watchers amid the CFTC's crackdown. Investors pulled $1.6 billion out of the exchange in the 72 hours following its moves. We break it all down with our panel this hour. And English football giant Manchester United turns a profit for the first time since the pandemic, but its debt is still around $650 million. Now, Man U did not mention anything regarding all that buyout talk, but we're taking a closer look. But first, let's get a check-in on the major indices an hour and a half into the trading day. Positive territory here. We see the Dow there up about 1/3% there. And we're also seeing the Nasdaq enjoying those gains as well, up 0.8%. The S&P lifted there as well by about 0.5% on the day as well. Let's also check in on the Treasury market. A lot of people wondering, perhaps waiting for that Fed pause. A lot of investors perhaps maybe jumping the gun though, but we're seeing at least for the short-term yields, those are on the rise. A different picture though for the 10-year, as we see that's also in negative territory along with the longer-term 30-year yield as well. All right, well, markets rising to the occasion as March draws to a close. But as the bulls come back, let's take a look at the big trends, gains, and key tickers this month. Joining us now, our very own Jared Blickery. Hey, Jared.
Hey, Rochelle, this year, 2023, has been the flip of last year. Tech stocks back in vogue, and let's explore why. First, the headline of the day or yesterday, the Nasdaq 100 back in a bull market. Now, this is a 6-month chart, so what's happened here, you take this low from late last year, and you take this high that we had yesterday, that closing high, guess what? That is 20%. It's only one definition of a bull market, and in fact, as you said, Rochelle, there have been other bull markets over the last couple of years. Now, here's another one that happened in the midst of that big decline. So in the middle of last year, we had a 20% rise from the low, but guess what? That low right here came down, took that low out from earlier, and we had a new bear market. Now we're back in a new bull. If it seems like it's kind of flip-flopping here, that's what happens with this tech-heavy index. And in particular, the Nasdaq 100 is really geared and weighted heavily towards the mega caps. Here's the Nasdaq 100 versus the Nasdaq Composite. Now, the 100 has 100 stocks, and the Composite has about 3,000. The 100, which has a higher concentration of those mega caps, is up 18% this year versus about 14, almost 15% for the Nasdaq Composite. And this gets to the story of interest rates. A lot of what we've seen this year, and I get back to my original statement that this year is the flip, the reverse of what happened last year, has to do with interest rates. And over the last 3 months or so, we've seen a big drop, and that's from the 10-year going from 4% all the way down below 3.4%. So we have a big range in here and a big drop, and that has kind of reinvigorated the tech trade. But is it going to last? Well, probably need lower rates to continue going in this direction. And we also need a weaker dollar for stocks overall to continue their ascent. And that's what we're seeing today. Here, the DXY, the US dollar index over 3 months, threatening to go into territory that we haven't seen since February. And again, this is risk supportive. So one more thing, let me just get to some heat maps and show you what's happened year to date. Here's the Nasdaq 100. I've been saying it's about the mega caps. Very apparent. Apple up 25%, Tesla up 60%, Nvidia up almost 90%, and that is where we're seeing the strength here, Rochelle.
Indeed. Thank you for that breakdown there. Our very own Jared Blickery. Well, fears of continued bank instability continue to ease, but the Fed rate rises that helped prompt the collapse of banks like Silicon Valley and Signature remain key to the Fed's inflation fight. For a look at how markets are coping with the risks, Kevin Gordon, Senior Investment Strategist at Charles Schwab, joins me now. Great to have you on. So we're seeing a lot of this investor enthusiasm in the mega caps right now. What should investors be keeping in mind on? They're really bracing for this Fed pause at the moment.
Yeah, I'm not sure if it's as much enthusiasm it is maybe about a flight to safety or a flight to quality up the cap spectrum because of some of the, kind of imbalances brewing when you move down the cap spectrum, particularly within the bank side. But in some ways, this is, I think, a replay. You were talking about the second bull market for the Nasdaq 100. In some ways, it's a replay of kind of hopes for a Fed pause, hopes for a Fed pivot that we saw last year when we had that June midsummer rally for mega cap tech. What's a little bit different this time is actually the correlation between mega cap tech and something like the 10-year Treasury yield has gone pretty significantly into positive territory. And if that holds, which is a very different dynamic than we saw all of last year, To me, if that holds, that's actually a bit of a worst case scenario for stocks maybe looking into the future if we are set to go into a recession, because as yields turn lower, that means stocks would turn lower too. So I'd keep an eye on that. It's not as much of a haven trade as you would think, but for right now, yeah, we're still seeing trends hold where you're moving up the cap spectrum. That's clearly been leading the market this year. If anything, the negative I would point out is that breadth has narrowed for the broader market, so you have less participation when you kind of widen the net out and go beyond some of the mega cap names you were talking about earlier.
I do want to ask you, because in your note you said that pausing might be the new tightening. Break that down for us.
So if we're at the end of the tightening cycle or hiking cycle for the Fed, or close to it, if they hike in May and that's the end, the idea is that if inflation continues to roll over and come down, that puts upward pressure on real rates. So in conjunction now with the credit crunch that we've had, courtesy of SVB, and then the fallout thereafter, that's tightening that's already, exacerbating what was already in the pipeline from a lending, standards position. So for us, keeping nominal rates at an elevated level of 5% if they get, in that range, that means that tightening will just sort of incrementally move, higher as we go throughout the year.
So then what's the investment strategy here if you're trying to allocate your portfolio and sort of bracing for some of these changes?
For us, it hasn't really changed over the past year, and we always have been kind of advocating, definitely for the better part of the past 6 months, moving up in quality, particularly on the earnings side of things. I mean, when you think about profit margins compressing broadly for the market itself, earnings revisions, positive earnings revisions moving lower, just net profitability on a trailing 12 or 6 month basis weakening substantially because now costs have been rising. Right. You want to find companies that are exhibiting those qualities. It's a smaller share now of the entire market, but even now when you have this coming credit crunch and difficulties stemming within the banking system and then lending standards potentially tightening here, and from our perspective, what we've been calling a rolling recession, now probably rolling into a more formal recession, you really have to look for companies that are exhibiting that strength. So the beauty of that is you don't have to pick a sector and jump in and out of sectors. You can just screen for that quality bias, strong balance sheets, a lot of cash on the balance sheet, and you can apply that to every sector, which is better in this environment because we've seen so many shifts, from sector to sector.
And how deep of a recession are you forecasting at the moment?
It's not, to us, it's if you're comparing it to something like the financial crisis, we don't see a replay of that. Every crisis, every recession is different. The difficulty with this one is we're still coming off of and dealing with some of the vagaries of COVID and the shutdown. So you have legacy stimulus still sort of holding up key parts of the economy, mainly services. And as goods inflation and goods disinflation has definitely taken hold, even deflation in some categories, what's interesting is that now you have a potentially larger hit to services, which is really what we were missing over the past year. So it's good from the Fed's perspective in dealing with the inflation fight and really getting at that core services number. But the math of the economy is just not as friendly because we're more services biased and heavily services oriented. So if you bring employment down and spending down in those channels, just kind of leads you to a more broad-based recession. So we've been in the camp that you'll eventually get one. Maybe it wouldn't be as bad as prior instances, but there's a lot of unknowns in terms of what happens in the banking sector. We think there's a little bit more to come in terms of imbalances and not another replay of SVB, hopefully, but when the Fed tightens and enters these kinds of aggressive cycles, things tend to break.
Because that is an issue. A lot of people wondering, is this just a reprieve from some of these banking worries? Will we see additional repercussions? We saw that Barclays strategist Joe Abate said that he sees a second wave of deposit outflows coming for banks as a lot of what they call sleeping depositors. Yeah. People, as it gets more into your psyche about the banks, it's let me look for better yields elsewhere. What are you seeing?
Yeah, I mean, I think, the initial shock, and maybe it's driven by kind of the new era of social media and social media driven bank runs. But that was definitely what you saw with SVB because it happened so quick. Now you're kind of dealing with the ripple effects. I kind of equate it to, something of an economic earthquake where you have the initial boom, then you have ripple effects after, and you kind of see what the aftershocks look like. And there's so many, sayings that you can attach to this. Warren Buffett saying when the tide goes out, you can see who's swimming without anything on. I think that we're sort of living that experiment right now. And this is the difficulty for the Fed because when you go back in history and look at prior financial crises, they haven't had to really deal with one in the context of an increasingly tight labor market and inflation that's still proving to be really sticky. Right. And in prior instances, they've kind of had a little bit of give in either of those areas. Right now, they don't. And I think we could go back to the meeting a couple of weeks ago and what Powell was saying, and the focus on inflation trying to rein it in, keep it down, not letting it get out of the bag again, I think is still their primary focus. And they've, in their mind, been able to separate the financial stability issue from inflation for now. Not sure how long that lasts, but they're dealing with a different set of circumstances than I think any Fed has had to in decades.
Indeed, and obviously they still raised by that quarter point, so they're still saying that inflation fight is there.
And it's not just them, it's other global central banks too.
Exactly, trying to stay the course as best they can. Great having you on there. Kevin Gordon, Senior Investment Strategist at Charles Schwab. Thank you for your time this morning. All right, coming up, what should you be investing in amid the current banking crisis? We're joined by Jonathan Boyer to discuss his top 3 stocks to watch. Stay tuned. As U.S. investors deal with rising rates, higher inflation, and a banking crisis, there are still places to put your money. Joining us now to give some stocks to watch is Jonathan Boyer, president of Boyer Research and the host of the World According to Boyer podcast. Good to have you on the show, Jonathan. So I want to get right to it and get to some of your picks, because a lot of these are really outside of the mainstream. So starting with Topgolf Callaway brands, why them?
Yeah, first, thank you for having me. And yes, they're outside the mainstream because I think that's the way investors will be able to make money over the next 3 to 5 years. Topgolf, Callaway Brands in particular, is an interesting story. It owns the traditional golf Callaway business, but during the last crisis, it opportunistically bought the 86% of Topgolf it already didn't own. And it's going to be half their EBITDA. So right now, you're getting a growth story at a value price. You're about 50% of their EBITDA in 2023 will be Topgolf, and there's lots of room for expansion. It's run by Chip Brewer, who's a fantastic operator, and we're really excited about it.
Now, another one, Liberty Braves Group. A lot of people perhaps not that familiar with this group.
Yeah, Liberty Braves is a John Malone-controlled company. It owns the Atlanta Braves baseball team. We have reason to believe over the next couple of years it will be sold, and John Malone is a rational seller of these assets. It's trading around $33 a share. We think it's easily worth in the mid-50s in a sale, and it owns valuable real estate as well.
And your third pick here, Markel Corporation, and you say it's often referred to as the baby Berkshire. Talk about that company and some of the comparisons there with Berkshire Hathaway.
Yeah, it's a fantastic company headed by a guy named Tom Gaynor, who and Berkshire owns 3.5% of it. It's an insurance company that, like Berkshire, uses the money it gets in premiums to buy common stocks. It also has something called Markel Ventures, where it opportunistically buys entire businesses. So there's a PE component there. It is a healthy balance sheet. And over the last month or so, when all the banks and financials sold off, it sold off in sympathy, and investors, I think, are getting a real attractive entry point.
So then let's also take a macro view. We were talking with our previous guest about this flight to quality. What are some of the trends that you're watching there and some of the risks that people should be aware of?
The risks, as always, is valuation. You have to know what you're paying, and you have to know what you're buying, and you have to buy things at a significant discount to intrinsic or private market value. You shouldn't chase things just because something is quality. You have to also look, what are you paying for that? So investors have to be very cognizant of that. And also, you also want to look at the balance sheet of these companies. Are they going to be able to survive 2 or 3 years if there's a kind of credit hiccups in the market?
And also wanted to take a look at some of these small cap companies as well. Any standouts for you there?
Well, Liberty Braves and Topgolf are considered in the small cap area. I think it's the cheapest area of the market. It's where investors, I think, have the biggest edge because a lot of institutions and the sell side really don't cover them. So people who are willing to do their homework can make a lot of money over the next 2 to 3 years investing in these kind of hidden gems.
So for people who are looking for, I guess, what would be considered safe havens, then, I mean, obviously bonds, interest rate sensitive, but where else could they be looking in terms of safe havens if they're not perhaps wanting to get into some of these small caps?
Well, I mean, you're getting a 4% yield in your money market, so you're taking very, very little risk. So and that's competition for stocks, and investors should really realize that. And treasuries could be attractive as well, but I would go very short term on these things. I would not chase. I would not take a duration risk.
And is there anything you like internationally? A lot of people like sort of looking at emerging markets, potentially China, as it continues to open up post-COVID. But are you seeing anything in the emerging markets that you like?
We prefer to invest in companies that have emerging market exposure, that are US-based companies. We just feel like the accounting and rule of law, et cetera, are more in our favor, and it's in our circle of competence.
And so in terms of your outlook, at a certain point when the Fed does pause and perhaps eventually start to cut rates, how would you suggest people pivot when they look at their portfolio?
I think investors should stop trying to figure out when or if the Fed is going to pivot and start looking at individual stocks. Are they cheap? Are they not? And not try and trade around these things. People should buy great companies and hold on to them through thick and thin.
All right, so great having you on the show. Jonathan Boyer there, president of Boyer Research and the host of the World According to Boyer podcast. Thank you so much.
Thank you.
All right, let's get a check-in on how the markets are faring as we head to this break. Sponsored by Tasty Trade. We see the Dow there still seeing some buying action there, but just up slightly, about 55 points. The S&P also seeing gains there, just slightly though as well, up about 19 points on the day. Tech-heavy Nasdaq there seeing stronger gains, up about 95 points. All right, coming up, Amazon continues to navigate economic headwinds by focusing on efficiency. Ali Garfinkel caught up with Amazon supply chain executives to get a deeper look into their new cost-cutting plans. We'll chat that next. Amazon's 2023 has come to be defined by cost cuts. As the e-commerce giant looks to navigate economic headwinds, it's focused on increasing efficiencies in every area of its business, from cloud services to retail. Yahoo Finance's Ali Garfinkel caught up with Amazon supply chain executive Melissa Nick for more insight into Amazon's cost-cutting efforts. So, Ali, what's the big takeaway?
Amazon's cost cutting dates back to the pandemic 3 years ago. That's the big takeaway. This story started a while back, and the pandemic really changed how Amazon operated, right? You had this massive demand shock, and what you ended up with was an Amazon that needed to grow fast and just get into whatever it takes mode to get packages from one place to another. And with Nick, I really delved into how cost cutting is actually going to work at these facilities. Because, right, Melissa Nick, for context, she manages 300 Amazon facilities there. And she has a network responsible for producing revenue greater than the GDP of Finland. So this is a huge undertaking, right? So, and there are three sort of key components to consider here, Rochelle. If you're Melissa Nick and you're looking at these almost 300 sites, this massive revenue, what do? And the answer is actually pretty simple. First, it comes down to something called getting inventory right, which sounds simple, but for a company like Amazon, actually is incredibly complicated. Think about it. Amazon is a place where you can buy a pot and a pan and a leaf blower. Right. She told me stories about how she walked through Amazon warehouses and really reassessed what needs to be there and what doesn't. For instance, snowblowers don't need to be in Florida is something she told me all about. Makes sense, right? The other thing, too, is the famous case she gave me was that she went to her warehouse in Kansas City, and there were a bunch of Raiders hats there, Raiders like the Las Vegas Raiders. And she was like, wait, there are 12 Raiders fans in Kansas City. So, for instance, that's the sort of thing that she's really looking at. What does it mean for Amazon inventory to really be where it's supposed to be, when it's supposed to be there? So there's that. And then the other thing is Amazon's changing packaging. Now, have you received one of those boxes that's just too big for whatever it is you bought on Amazon?
Unnecessarily
yes,
so.
And it's like this, and the thing is like this.
Yes.
Yes, whatever it is. Like if it's for instance, if it's like a package of pencils or something and the box is yay big, that's going to be no more at Amazon. The goal is to have more efficient packaging. Now, what that means is if I order this laptop right here, it's going to be packaged exactly specifically to that laptop. They're investing in automation that's going to change that. Now, how does this all shake out to efficiency? And that actually ties back to the last thing, which is how the trucks fill. This is called fill rate. Basically, the goal for Amazon moving forward is that not only are these packages smaller, they can fit more of them in trucks, and the trucks are fuller. Amazon has a customer promise to deliver quickly. So during the pandemic, it was a lot of, okay, we've got to do this. We've got to do it now. We're going to ship from LA to Kansas City to Texas if we have to. Whereas now it's, okay, where does everything need to be? Are the trucks full? It's a much slower approach. What you described to me was thoughtful. It was, the thing about it that was really interesting is for her, it was very clear that this was key to Amazon moving forward. But listening to her describe it, it also sounds like it was really possible to make a lot of these changes.
And it's interesting because we're seeing a lot of retailers who were battling with inventory. Amazon is not really one of the ones we think of, just because they deal with so many, obviously, third-party retailers as well. How much of a game changer do you think this could be to really have this streamlined year of efficiency, as Mark Zuckerberg also puts it?
Well, it's a big theme in tech across the board right now, Rochelle. But I think it could be a really big game changer, because the reality for Amazon is let's take everything else out of it. The most visible part of Amazon, to me, to most consumers, is that box you get with the arrow. Right, and if those boxes can start delivering faster, more efficiently, costing less, it's a big deal for the company. And I think in the end, if you're Melissa Nick, you're looking at this and saying, okay, what are the small changes we can make getting from point A to point B? And I think that for Amazon, it will absolutely matter. Yes, of course, they're doing all these layoffs, so there are going to be costs cut in the other parts of the business. To date, they've laid off, I believe 27,000 corporate workers, but they are still hiring in these warehouses. So, I think it is a priority for Amazon getting these warehouses right, but I think it's certainly not the only thing looking ahead that they're looking at.
So certainly strategic cost cutting, not just sort of cutting across the board. Great stuff, as always, our very own Ali Garfinkel. All right, turning to artificial intelligence, big tech leaders are calling for a 6-month pause on experiments for AI systems more powerful than GPT-4. Yahoo Finance's Dave Briggs broke down shortly after the announcement. Take a listen.
Elon Musk is urging us to push the pause button for 6 months on AI. In an open letter from the Future of Life Institute, Mr. Musk, along with Apple co-founder Steve Wozniak, 2020 presidential candidate Andrew Yang, and dozens of other tech leaders, writing, quote, "Powerful AI systems should be developed only once we are confident that their effects will be positive and their risks will be manageable. These are certainly valid concerns, but Elon Musk, this guy might be the last person on the planet who should deliver this message. Take, for example, Tesla's fully autonomous driving program, the subject of a class action lawsuit before a San Francisco federal court. I asked ChatGPT what concerns it has about Elon's autonomous cars, and it told me, quote, "There have been several accidents involving them, some of which have been fatal. There are concerns the technology is not yet advanced enough to ensure safety for passengers and other road users." Chat cited legal and regulatory issues, even ethical concerns around how decisions will be made in situations where there are no clear ethical solutions. This letter also asks, should we let machines flood our information channels with propaganda and untruth? Where have I heard that before? Has Elon scrolled Twitter since he took over? It's literally a breeding ground for propaganda and untruths. So maybe just sit this one out, Elon. As for a 6-month pause, consider that ChatGPT amassed 100 million active users in 2 months, the fastest growing consumer app ever. Pumping the brakes now on AI after the entire tech world has put the pedal to the metal is not feasible. It's the biggest investor story in years, maybe decades. Bill Gates himself just called it as fundamental as the creation of the internet or mobile phone. There is no putting this multi-billion-dollar genie back in the bottle.
Well, staying on the subject of artificial intelligence, Microsoft is now looking to generate revenue from its AI-powered Bing search service with advertising. But just how much of an opportunity exists in the AI ad market? Yahoo Finance's Dan Howley has the details. You know, we've been looking at this ad space, so this is an interesting move.
Yeah, it really is. And I just want to point out real quick, you know, when it comes to Microsoft and the opportunity that it has for gaining market share and revenue, when Microsoft's CFO, Amy Hood, had been part of the announcement where Bing was debuted along using the ChatGPT OpenAI technology. She had said that 1 point of search advertising market share is worth about $2 billion in annual revenue. So look, they are trying to pull that revenue away, and how they're going to do that is by adding advertisements. Now, this is coming to Microsoft's chat version of Bing. It's so when you go into the actual chat box, not when you're doing standard search on Bing, although, you know, getting everybody onto Bing in the first place is probably a good way to start. Bing, when you do chat, will eventually be providing you ads. And so there's been a large discussion about what that means, especially for the publishers who are, you know, their content is being used to inform Bing. And so part of that, Microsoft says, is part of its Microsoft Start Publishers program. And so essentially what they're calling for is a revenue split with publishers when their content is used in a chat response from Bing. There's hover over links that they're thinking of doing where you'll hover over a particular citation and it'll open up a larger link window that you can look at. But this is something that I think a lot of publishers have been concerned about. One of my former editors at Tom's Hardware, a enthusiast site, has been regularly pounding away at this, saying, look, you know, Bing, ChatGPT, Bard, they're all going to be using the work of journalists and basically taking it for themselves. People won't need to go to websites to get that kind of content that they would normally need because it'll just be presented to them in a chat box. So Microsoft seems to be erring on the side of caution here, not trying to bother or annoy publishers and trying to say, look, we'll advertise, but maybe we'll split that revenue with you, or we're hoping to split that revenue with you. Because look, you can't power Bing and the chat AI without content from publishers. So we're just going to have to see how this kind of shakes out. You know, if it eventually becomes or comes to the point where you can ask Bing a question and you don't have to go to a website, then why would you click a link to go to that website? The answer is just presented to you right there. I think this is going to be an interesting problem that the industry, tech and publishing, are going to have to figure out.
And that's interesting. It's sort of cannibalizing, as you mentioned there. Why would you have to go to the website? You already have the information there. Interesting stuff. Yahoo Finance tech editor Dan Howley, thank you so much. All right, coming up, we dive into the CFTC's lawsuit against Binance and what kind of impact it might have on the crypto world. Stay tuned.
The two pioneers that created this nascent industry and made it global, Sam Bankman-Fried and CZ. Then they went to war against each other, just like in Greek mythology. And one of them won. CZ definitely bankrupted Sam Bankman-Fried by using the FTT token in the last stroke on that November 6th, 550 million right into his heart, and he had to, declare bankruptcy. Then, of course, all the allegations and all the charges.
But now Binance CEO CZ in some trouble of his own as the Commodity Futures Trading Commission hits crypto exchange Binance with a lawsuit, a civil lawsuit there. The CFTC's claims against Binance include operating an illegal digital asset derivatives exchange in the US and willful evasion of federal laws. US regulators allege Binance instructed employees and customers to circumvent compliance controls in order to maximize profits. Well, how will this all trickle down into the crypto landscape? Here to discuss is Scott Melker, host of the Wolf of All Streets podcast, along with Brady Dale, Axios crypto reporter, and he's also the author of forthcoming book SBF, How the FTX Bankruptcy Unwound Crypto's Very Bad Good Guy. And also joining us, Yahoo Finance's David Hollerith with us for this discussion. So first, Brady, I want to start with you. What are the most likely scenarios for Binance at this point?
Well, I think the most likely scenario is that Binance gets hit with a fine and just kind of moves away from doing business in the US. But the thing about this case, as you rightly pointed out, Rochelle, is it's a civil case, but it hints at a lot of other darker activities at Binance, which seem to suggest that there could be some kind of criminal procedure underway. And to me, either the government is waiting to make an arrest of CZ or someone high up, or if they can't do that, I wonder, as Nick Day at CoinDesk pointed out yesterday in his newsletter, if they're going to make a move on the various Western cloud companies that Binance relies on to operate. And if that were to happen, that would really hurt Binance badly. But if it stays just a CFTC action, that really probably won't be that big of a deal to Binance.
Yeah, and to that point, it is kind of interesting that it's a pretty simple lawsuit in a way, but there are all these details that are sort of not a part of the charges that are being unearthed. And we do know that just based on what Binance has even said, is that Binance and the Justice Department have been looking to settle charges for some time, and we don't know whether or not this adds to it or what that could look like. But it does call into question a lot of red flags. But I do want to point out the charges so far have not included anything that implies, at least in this suit, that Binance has been doing the same thing as FTX, and that's obviously the primary concern. So,
yeah. It's very unlikely that there is a giant hole in Binance's balance sheet like there was at FTX. It just would be very surprising.
And Scott, I want to bring you in here because obviously we've had this conversation about regulation by enforcement. I mean, we already knew Gary Gensler was already gearing up, but then combined with the CFTC, and then not really having a consistent definition when it comes to all cryptocurrencies. What is this doing to the crypto landscape right now?
Well, I think what you just described is the quiet turf battle between the CFTC and the SEC that's been ongoing for quite a while. And no mistake that the CFTC specifically listed Bitcoin, Ethereum, Litecoin, and surprisingly a few stable coins as commodities in this action against Binance, when the SEC and Gary Gensler have made it extremely clear that anything not named Binance is likely a security. So when you talk about what it's done for the landscape, I think it's important to note that this is a global industry, so it's done very little to affect the landscape, I would say, outside of the United States, as regulators in other countries and jurisdictions have seemingly moved on and started to give some sensible ideas as to how to handle this asset class. But in the United States, it's put a massive pause in general on innovation and people wanting to be entrepreneurs in this space in this country, and basically just a massive amount of confusion and people looking for clarity as to what these assets are and what that means for the future. It's a broken system that we have. We have absolutely no clarity. And you can make the argument that regulators, when the only, obviously the only tool you have is a hammer, everything looks like a nail, and that's how they're approaching it. So maybe it comes down to needing some legislation to give these regulators more of a direction.
Yeah, to Scott's point, the issue here is that there aren't clear laws, and a lot of people don't actually, a lot of average investors do not care whether or not a cryptocurrency is a security or a commodity. But that's a big deal, obviously, in the U.S. for how they're regulated and how companies that sell or offer them are regulated. And so it's created this whole dynamic where there's not perfect alignment, at least between the agencies, the CFTC and the SEC, about what they are. And then also to Brady's point, I think it is good to point out too, just in a realistic worst case scenario for Binance, if the worst were to happen, we would definitely see a midterm to short-term to midterm impact on the cryptocurrency market. I mean, if we look back at the FTX collapse, Binance kind of arose as an unexpected lender of last resort for the industry.
And Brady, to that point.
Oh, sorry, go ahead.
Well, I was going to say then, so if obviously we first had FTX being a sort of white knight saving some of these smaller exchanges, then comes Binance. What is next then in terms of the potential white knight, or where some of these inflows are going to be headed, if not to Binance?
Well, they'll just go to other exchanges. They'll go to DeFi. The cryptocurrency world is extremely resilient. And I think, if you ask what is the real danger for that market, Bitcoin price is doing pretty good. Ethereum price is doing pretty good. Global markets are not in a panic about this, though obviously if, for example, Binance went down, that would be terrible in the short to medium term. That would really hurt. There would be companies wiped out. But crypto would survive. There's nothing in the cryptocurrency world that's too big to fail except for the Bitcoin network and the Ethereum network themselves. That said, in the United States, I think it's worth broadening this out from the CFTC. I think, honestly, it's clear now that the Biden administration itself, not just the agencies, is on a full-on attack on the cryptocurrency market. They kind of want to run it out of the U.S., and other countries are going to have to pick it up. And obviously, that's not going to be good. It's the biggest economy in the world. So this is about much more than the CFTC and the SEC. It's all of DC.
Yeah, that's a good point. I mean, if we look at just the Custodia, which obviously was trying to get a banking license from the Federal Reserve to, sell cryptocurrencies and to be a crypto bank, essentially, that's the same issue. And banking access has sort of changed the market in a lot of ways. So to that point, like it has definitely become a thing that's much more overarching, with U.S. regulators being skeptical of crypto regulation at all, which has been kind of odd, as it's, for the last year, it's been sort of a flip around sort of what the dialogue has been between industry and the U.S. Public sector.
And Scott, I do want to ask you about choke point 2.0 that you noted. Explain that, because a lot of people might be wondering what's next for the industry.
I think he gave some good context with Custodia Bank. I speak with Caitlin Long, who's the CEO, quite often. That was going to be a fully backed bank. Impossible to have a bank run like we saw with Silicon Valley or Silvergate. And their master license was rejected simply because they were likely to service crypto clients. And now we're seeing, even with the sale of Signature Bank, that $4 billion of deposits were bought, but they've told crypto companies that they will not be serviced any longer. They need to find a new bank within the next week. And if they don't, they're going to receive a check in the mail to their last address on file. There's a very, very clear war right now of the entire United States government, but definitely bank regulators against the crypto industry, trying to cut off any access of the industry. As we've heard before, you can't kill Bitcoin, you can't kill Ethereum. These assets will exist forever. They are definitely too big to fail. But what they can do is attempt to cut off the on-ramps and off-ramps for American companies and for American retail to access it. Imagine if you can use Bitcoin, Ethereum as much as you want, but you can't get in and out of the dollar. That is a huge point of failure that they're trying to exploit. And this is where the war is really being fought. I mean, they even had Chairman of the FDIC, Bloomberg, in Congress yesterday, and he completely contradicted himself multiple times with Tom Emmer and other Congress people questioning him about this. What's happening with Signet? Oh, Signet was sold. Another one asked him, what's happening with Signet? Which, by the way, is how the crypto industry through Signature settles 24/7. Oh, we're still looking into that. I mean, literally contradicting himself within 10 minutes directly. There's a clear directive right now to crush the banking access for the crypto industry, and that is Operation Choke Point 2.0.
We'll continue.
And if I could jump in there, one thing I think a conclusion people jump to when it comes to exchanges, which I think confuses them, is they think if a lot of people withdrawing from an exchange, then that's a quote unquote bank run. And so the exchange is in danger. But the truth is exchanges just aren't like banks. Banks take in deposits and then lend the money out. So no bank can survive a bank run if lots of people want to withdraw quickly. But if an exchange is functioning properly, every single deposit anyone has made, it's all just there. So if lots of people withdraw the money, it'll hurt them. It hurts business. But unless they're doing something wrong, like FTX was, and misusing customer funds, it's all there and the business just winds down gradually in an orderly fashion, but nobody comes up short, right? And my guess is Binance is so big at this point that probably all the money is there because it's not even worth it to screw around with it in some other way.
And definitely an important distinction there when people try to compare sort of runs on exchanges versus bank runs. Great having you all here. Axios crypto reporter Brady Dale and Scott Melkup, the host of the Wolf of All Streets podcast. Thank you for joining us today, along with our very own David Hollerith. All right, coming up, the markets are making welcome gains after a month of turmoil. We discuss if the worst is behind us or is there still another shoe to drop. Stick around, we discuss next. The markets are making welcome gains after a month of turmoil, but is the worst of the banking crisis behind us? Joining me now to break it all down is our very own Ines Ferre. Hey, Ines.
Hey, Rochelle, and there are several factors that we're watching when it comes to the banking sector, and some of them that we've spoken about over the last week or so. We've talked about outflows, deposit outflows going from the smaller community banks into the bigger banks, but also we have to talk about outflows of going into money markets, because depositors have now noticed that they can get more money if they have their money in a money market, in a CD, in treasuries, and money markets are basically instruments which invest in highly liquid and near-term instruments, and they can range anywhere between a 2 to 3% yield in some cases. So banks have had to see their money going into these money markets, and in fact, the amount that is now into money market mutual funds has now exceeded $5 trillion, and you can see a chart that was put up by Bloomberg. So from the beginning of January of 2022 to March 2023. And that can pose a risk to the U.S. economy if it grows too much. Industry watchers are saying, look, depositors are noticing they can get more yield for their money in these money market mutual funds. And so you can expect more flows into those. So what does this create? This creates more competition for deposits among the smaller, especially regional banks and the smaller banks. It'll create this competition for them to give more yield for their deposits, and even in the large banks as well. So that heats up that competition, and what it does is it impacts net interest margin. This is a measure of profitability for the banks. Wedbush just came out with a note recently saying that first quarter earnings are likely to be pressured because of these factors. You also have to think about loans when you're talking about banks, because now the underwriting for loans is going to get tighter in a decelerating economy. We know that credit contracts, and so you are going to see tighter restrictions when it comes to loans. Also, pay attention to the commercial real estate, because a lot of the smaller, more regional banks are also exposed to commercial real estate. And we've seen companies saying that they are going to reduce their footprint when it comes to real estate. We just saw an announcement from Roku, Electronic Arts yesterday as well, talking about this. So you can expect that in this hybrid world, companies don't need as much commercial real estate. And then finally, just want to mention the FDIC. Perhaps thinking about a special assessment on the big banks because of the failures that we've had with SVB. The FDIC has to now shore up its insurance fund. And how is it going to do this? Well, through a special assessment, possibly, especially for the big banks, which would receive the bulk of the levies here, so that the smaller regional banks don't have to receive the brunt of it. But nevertheless, when you're talking about this, you're talking about fees, you're talking about fees to eventually the end user, the customer, the depositor, because it all boils down to that the people who are depositing in these banks. It's a lot to take in and a lot to kind of digest when it comes to this, but no, the risks of this are definitely, these are some of the aspects that we're watching.
I'm sure customers will be keeping a close eye if they do see those fees start to trickle down to them. Ines Ferre, thank you so much. All right, well, strong earnings out this morning from Manchester United, with the team announcing they've sold a record-breaking 2.3 million tickets for their current season. But despite rumors of a potential takeover, the club failed to comment on any impending sale. Joining me now is Mark Patrikoff, founder and CEO of Patrikoff Co. Thank you for joining me this morning. Starting with my nemesis, Manchester United. I am an Arsenal fan.
I heard.
But I want to break down some of these Q2 earnings here. What do you think some of these potential, not just the investors, but the potential buyers will be honing in on?
You know, in a way, the earnings are indicative of just overall global popularization of sport, and certainly soccer after the World Cup. We know everybody loves soccer, football for you, go Gunners. But it also tells you that these purchasers who are lining up to acquire assets like that are becoming a smaller and smaller group who can actually pull the trigger. So PIF owns Newcastle. They're worth about $800 billion. I think one of the bidders has been announced, or potential bidders from Manchester, is Sir Ratcliffe. He's worth, I think it's 25 billion. He's probably the second wealthiest person in the UK. It's created a very small set of potential acquirers for these clubs, unless What's historically happened in the UK is you see communities own their teams. And I wonder over time, does that replicate itself in the US? And do you look at public offerings or sovereign funds as really the only options to acquire assets that are worth 6, 7, 8 billion pounds, in your case, dollars if it's the Commanders or someone here?
So then what are the expectations then for the potential sale? You mentioned some of the bidders here.
Well, I think the expectations are that this is a prized asset. Scarcity value counts for a lot. I don't think whether earnings are up, by a percent or down by a percent matter a whole amount. I mean, they're going to hold these assets for a long time. So the question really is, how high can the values go, and are there enough buyers, which correlates to the values. Ultimately, there's got to be a buyer. It doesn't matter what the value is if no one can pay it. So it all kind of interconnects. And I think at the end of the day, these assets have proven to continue to accrue value for their shareholders. So the numbers go up.
Well, then, as we shift gears then and talk to U.S. football, Washington Commanders obviously up for sale in the spotlight as well, looking for bids. Talk about that aspect, because obviously this could be a record-breaking a deal here.
Well, I think we're going to see almost every sale in the NFL be a record-breaking bid in the next 10, 15 years. I mean, between now and let's say 2033, you'll see 10, 15 teams trade. They're going to have to. Some of the owners who own the teams today can't afford to continue owning them for estate tax reasons and other so forth. Just guaranteed contracts like Deshaun Watson, having the owners needing to put $250 million in escrow. There's only so many people who can acquire these businesses. No different, frankly, than looking at the Premier League. So it really addresses an issue around, do private equity funds start playing in a more serious way, the way Silver Lake owns a piece of the Garden, for example, or MSG. It starts to put a valuation on the business, which makes it easier then to bring in other bidders. And it's a pretty complicated process, but when you think about it long term, I think the only two real options 10 years from now are either massive funds that have the kind of capital under management like a PIF or a Silver Lake, or potentially you see these as public assets, which, by the way, I think is interesting too, because it provides some access for the community to have some say, and it addresses diversity, it addresses all the connections to the locally important aspects of what these clubs and teams mean.
And do you get the sense that there's an appetite? Oh no, we're also going to talk a little bit of baseball here. Is there an appetite to have more of these go public?
I think so. I was talking to somebody yesterday who's a minority owner in the Reds, and he said if the Reds, which I think are now valued about $1.1 billion, which makes sense if the Yankees are worth $7 billion plus or minus. If he said they put that company up on Nasdaq tomorrow, the shares would be gone in 5 minutes by local people. So I think the passion and connection of these teams has in a way gotten lost. I mean, I don't know how you felt when the Lerners or different the Glazers came into the UK and started buying Premier League teams. There's something to be said for maintaining that connection. I mean, the NFL started with community-owned teams in a handful of markets, primarily because they were industrial cities that had the capital to build and compete in sports.
And you raise a good point. I know for British football, it's very much, everything is very much community-based. So then, yes, it was tough to see some of these, big billionaires come in who don't have the same love for the sport that we all grew up with.
And I love that the Steinbrenners still own the Yankees. And you're wearing a red jacket, so I know if the Arsenal, a share in Arsenal was available, you might take advantage of that.
You better believe it. And so just quickly, talking baseball, it's opening day. My Nats are also playing. Talk about some of the deals we're seeing there. We know that we're trying to also see increased pay for minor leaguers right now.
Look, baseball is such an interesting sport. I mean, it always has been, America's sport. I mean, the NFL in some respects has trumped that in terms of viewership. And, baseball has somewhat forgotten about how to, connect with younger audiences. But the truth is, they're trying really hard. It's still an incredibly passionate, powerful fan base. They cut the spring training games because the new pitch count clock by 26 minutes. That's going to go a long way. I think baseball is not going anywhere as an important fixture in American sports. Happy to see the Yankees playing at 1 o'clock against the Giants. Yankee Stadium will be sold out. I'm sure the Nats will do the same with their home opener.
We usually do. Always great to have you on. Mark Patrikoff there. Thank you so much for joining me this morning. All right, well, let's get you a final check of the markets as we head into the noon hour. Still seeing positive gains here, but pulling back a little bit, though. The Dow up just about 38 points on the day. The S&P 500 up slightly, about 18 points. Tech-heavy Nasdaq also up there, about 0.7 points, at least seeing the strongest gains, especially in the mega caps, as we see investors with a flight to quality. Well, that will do it for now. I'm Rochelle Akutho, but I'll be back with you at 11 a.m. Eastern tomorrow. See you then.